Okay. So yeah, let's just start. Okay. Let's just start. Okay. So let's come here. Okay. Okay. So we'll be using two situations to introduce the topic. Okay. The first one is, let's assume that, okay, you are a student and you have purchased the undergraduate form. Okay, you just completed SHS and you have purchased what? Undergraduate form for UPSC. Okay, undergraduate form for UPSC. The question is, from the time that you have purchased the form, that the undergraduate form, okay, do you have to start saving towards your school fees, or do you have to start saving towards what? Towards admission fee and other costs that you are going to be incurring in school? Do you have to start saving towards that particular arrangement? You have just purchased the form, okay, and you are here to be picked by the school. And I'm asking, do you have to start putting money aside? Do you have to start putting money somewhere towards the school fees that you are going to be paying?
Yes, please.
Yes, that is an optimistic person.
Okay, leave the issue of being an optimistic. Okay, when will you have to pay the school fees? When will you have to start saving money towards paying off the school fees?
When
Okay. So what I also think is right from the point of you having the intention of going to the university.
Okay, having the intention of going to the school doesn't mean that you are in the school, isn't it?
Yes, please.
Okay, so do you have any obligation to pay the school? Are you owing the school any fee at the time that you purchase the form?
No, please.
So what will you be making provisions for nothing that you have no obligation to settle? Okay, for your own point of view, you can say that, okay, you are applying with good grace. So you can what? You are sure that you are going to be what? You are going to be picked by the school. Okay, you haven't been given any fees. You don't have any obligation to settle the school any fees. Okay, you don't have any obligation at this moment to what? To pay school fees. But if you are a student of the UPSC, if you are a student of UPSC, what will happen is that before you continue the school, you have to pay school fees. You are already a student. So you have the obligation to pay the school fees before you even enter the school. By the time that you are applying, what are the chances of you being picked? Okay, you don't even know whether they are going to pick you or they are not going to pick you. And at this particular point, you don't even have any what? You are not owing the school any financial obligation that you are going to be saving money towards. Okay, so you can't start making provision for the fees. No, because you don't have any obligation to. Please, can you hear me? Can I tell you? Please, can you hear me now?
Is it my network? I can't hear you.
I think it's coming up.
It's okay.
Coming back.
Okay. Okay. So I'm saying that at this particular point, you are not owing UPSC any fee. So you cannot be putting money there. If you are putting the money there, what are you going to be settled? You are not owing the school. So if you are putting money there, who are you going to pay?
Yes, ma'am.
Okay, who are you going to pay? So you can only start providing for that particular money if you have any obligation to what? To settle what? The school fees. If you have any obligation, you are not yet a student of UPSC. There is no way you have to start. If you are saving money, we ask you, okay, what are you saving the money for? Okay, I'm owing you UPSC this amount of money. That's what saving money means, that you are owing somebody and you are going to be paying at a particular date. Okay, so you are saving money. We ask you, what are you saving the money for? Okay, I've applied for UPSC and I'm saving money for the school fees. Okay, what is assurance that they are going to pick you? But if you receive the admission form at that particular time, you have an obligation to pay the school fees. So you can say that, okay, I've received an admission from UPSC and what? I'm saving towards what? Towards the payment of the school fees. So receiving the admission letter presents an obligation to you to pay. So you can start saving for that particular time. Okay. But as soon as you purchase the form, there is no way you should start saving. You cannot make provision at that time because you don't have any obligation. Okay, you cannot even estimate the amount of school fees that you are going to be paying. You don't know how much you are going to be paying. Okay, since you don't have any obligation, there is no way you are going to be paying any money to settle that particular obligation because you don't have any liability to settle at this particular date. Okay, you cannot make provision. Okay, let's come here. Let's come to another situation. Okay, you have actually, okay, let's say you have actually bashed someone's car. Okay, and so you have the mistake is coming from you. So some of the things have damaged. Okay, and the cost of the thing is 20,000. Okay, the cost of the thing is, let's say 2,000. Okay, let's say 2,000. Okay, so the mistake is coming from you and you have destroyed some of the parts of the person's car. Okay, and the cost of the items destroyed is what? Is 2,000. Okay, let's say the person is now saying that, okay, don't worry, I'm going to fix this myself. Okay, the person is telling you that, don't worry, I'm going to fix this myself. Okay, don't worry, I'm going to fix. So don't worry. The person is telling you, don't worry. Okay. Will you be saying that you are going to be paying the person in 2 months' time? So you have to start putting money aside for the payment of the 2,000.
No.
Will you be putting money aside for the settlement of the 2,000 in 2 months' time?
I don't think so.
No, sir, because the person said you shouldn't worry paying back.
So you cannot be telling somebody that, okay, we have bashed someone's car and the cost of the item is 2,000. So I have to be putting money aside. The person told you that, don't worry, I'll fix it myself. So you don't have any obligation. You don't have any obligation to fulfill to that particular person. Okay. You are not owing the person any amount. Although the cost of the repairs can be ascertained, but you don't owe the person any amount at this particular time. So you cannot make provision, or you cannot be putting money aside for the settlement of the 2,000. But let's come here. Assuming you have badged the car and the repairs is 2,000, and the person is saying that I'll take the car to the mechanic, after I'm done, you come and pay. And we know that the cost of the repairs now, the time we have agreed on everything, and the person says that the cost of the repairs is 2,000. So you pay it after the mechanic is done with He's done with everything. Okay. Are you owing the person any amount currently?
Yes.
You are owing the person how much?
Insofar as you don't know, but then the person
don't know
has.
the
No, the person said 2,000. The person said the cost of the repairs is 2,000, but you pay after the mechanic is done with the car.
Oh, okay. Then it's 2,000.
Okay. So for this particular, you can see that you have a present obligation to settle how much in 2 months' time.
2,000.
Can we determine the value of the amount?
Yes.
Okay.
Yes.
If we want to settle this, would there be any outflow of economic resources?
Yes.
Yes, sir.
So at this particular time, you can go to your financial statement. If you are entity, you can go to financial statement and recognize 2,000 as an expense. Okay. Why is it an expense? It's just like you have purchased a thing from the person on credit. Okay. Provisions are just like credit transactions. Okay. You have the thing happened today, but just that you don't have money. It's just like you purchase car from somebody for 2,000. Okay. On credit. What you do is that you are going to be having debit car, and you credit the creditors of 2,000. Although you'll be settling this amount in the future time. Okay. So provisions are just like credit transactions. Okay. We badge the car and we're supposed to pay 2,000 today. Okay, we're supposed to pay 2,000 today, but we don't have the money to pay. Okay, so we are going to be paying in the future. It means that we are currently owing the person 2,000. This amount that you are paying is not an asset that is coming in. It's a cost to you. It's an expenditure. So you take it to profit or loss as a provision, and you recognize a liability of 2,000, which we call a provision in the statement of financial position as a liability. Okay, this is what we call, this is basically the idea about a provision. Okay, why should this particular standard comes in? Okay, this standard is coming in, or the board is issuing this standard because accountant just stand up and make provisions based on mere intentions, like the one that we have, the school issue over here. You have an intention of going to UPSA, but you don't have any obligation to pay whatever amount that you are putting aside. You don't have any obligation. So why will you be saving money towards something that you are not going to be owing the person anything? At that particular moment, you are not owing UPSA, you are not owing UPSA any amount, but you are just being optimistic. In business, that issue of being optimistic does not come into play. If you cannot be saying that you are owing UPSA admission fee of this amount, because you putting money aside is a sign that you are owing UPSA. Meanwhile, UPSA has not given any service, UPSA has not given anything to you. Okay, so accountants normally make provision based on mere intentions. We are going to be buying car. Okay, we are going to be buying car. We just have the intention of buying car. There is no obligation to buy car. We don't have any present obligation to pay the car dealer. And we say that we are going to be buying car. So since we are going to be buying car, let's make provision for the purchase of the car. No. So the board realized that most of the accountants, they make provisions based on mere intentions. Okay, you should make provision based on our obligation. The provision that we are talking about over here is not a provision for doubtful debts. Okay, it's not a provision for discount allowed. They are not contra assets. The provision that we are talking about over here is not that you have sold these amounts of goods to the person and you are not sure that the person will not pay. So you are making a provision for the unforeseen situations. No. That is not the provision that we are talking about over here. The provision that we are talking about over here is a liability, but we don't know when the liability will be settled. Okay, so you have bought someone's car, and the amount that you should pay today is 2,000. Because the person is saying that you pay in 3 months' time. Okay, the person is saying that you pay in 3 months' time. So what will happen is that you have to recognize 2,000 in the books as a liability, because it's just like you are buying something from the person on credit. Okay, but we don't know when we are going to be settling this. That's what we call it a provision. It's just a money that we are setting aside to fulfill a present obligation that will be settled in the future. Okay, that's the liability. That's the provision that we are talking about over here. The provision that we are talking about over here is a liability. It's not a provision for doubtful debt. It's not a provision for discount allowed. No, it's a liability that we are going to be settling, but we don't know when we are going to be settling it. Okay, example will be you have sold goods to a customer, and the customer has used the goods, and the customer has now suffered injury as a result of the usage of the goods. Okay, the customer has now taken the issue to court. Okay, you can see that any amount that you are going to be paying to the customer based on the outcome of the court case. Okay, based on the outcome of the court case. So presently, you don't have any obligation to pay that particular person, because the court is here to judge whether you are wrong or you are right. Okay, but your lawyer is telling you that there is a 70% chance that we are going to be losing the case. What it means is that the case has been lost in advance, because it is the lawyers that are going to be that are going to be defending you. If they are saying that there's a 70% chance that we are going to be losing the case, it means that the case has been lost. Okay, the case has been has been lost. So what will happen is that the case has already been lost, but we are just waiting for the court to confirm that you have lost the case. Okay, what it means is that you should have paid the person 20,000 now. Okay, you should have paid the person 20,000 now. But because you are waiting for the money to come, or you are waiting for the court to decide that, okay, you have lost the case, then you pay at that time. At the time that the lawyer is telling you that there's a 70% chance that the case has been lost, in spirit, you have lost the case, but you are just waiting for it on paper. So it just means that you are owing the person from the time that the case has been declared as a loss. So you make provision, just that you don't have money to settle at that time. So you settle at the time that the court will say that this and this. Okay, those are the things that we call provision. That's a typical example of provision. It's a liability, but we don't know when it will be settled. It's a liability, but we don't know when it will be settled. not provision for doubtful debt. Provision for doubtful debts are not part of this one. The provision that we are going to be looking at is a liability. Okay, it's a liability. So let's come here. When do you recognize provision in the books? Okay, when do you recognize provision in the books? Okay, so we look at the recognition criteria, although we have explained that one already. Recognition of provision. So when do we recognize provision in the books? Okay. The first one is that you can look at the case of this person. This student is not owing UPSA any amount. So you don't have any financial obligation to fulfill to UPSA in the future. You don't have any present financial obligation that will be settled in the future. Therefore, you cannot recognize provision. So if you want to recognize provision, since provision is a liability, there should be a present obligation. There should be a present obligation as a result of past event or whatever it will be the case. Provision is a liability, so it's supposed to meet the definition of a liability and the recognition criteria of a liability. So the first thing is that there should be a present obligation. Okay, there should be a present obligation. Okay, which can be legal or it can be constructive. So we are going to be looking at the two arising from past events. Okay, arising from past events. The present obligation can be legal obligation, or it can be what we call the constructive obligation. If you talk about legal obligation, we are talking about obligations that are being presented to the entity as a result of legislations. So we can have obligations that are coming in as a result of legislations. Okay, what do we call legislations? If you have the government that is saying that any company that is engaging in manufacturing of cement, it should buy it should buy protective equipment for all of its workers. Okay, what will happen is that if the entity is in the process of recruiting new employees, new staffs, what would the entity do is that, okay, we are very sure that the recruiting process will be successful, and we are going to be recruiting 10 people. Okay, recruiting 10 people means that we have to buy protective equipment for them. So as soon as the entity starts with the recruitment process, they can now make provision for the purchase of the protective equipment. Okay, what do we mean by making a provision for that one? Because the law of Ghana says that when entity that is producing or engaging in manufacturing of cement, whenever they employ somebody, they have to purchase equipment or protective equipment for those people. Okay, you cannot just stand up and buy the protective equipment. You are buying it for employees. Now you are in the process of recruiting people now, and you know that you have all the evidence to show that you are going to be recruiting 10 people. Okay, you are going to be recruiting 10 people. We have a present obligation now to purchase the equipment. How is the present obligation coming? The law says that we should buy protective equipment for our workers, and we are recruiting 10 people. So it means that since we are going to be employing these people, we are going to be supplying them with protective equipment, and we are here to buy them. So you can recognize provision for that one because you have an obligation. The law has actually placed that particular obligation on you. Is by law. Okay, the legal can sometimes be from contracts. Okay, it can sometimes be from contracts. We can sign contracts. Okay, we can sign contracts now. We can sign contracts now. Okay, included in the contract, we are saying that if you are not able to complete the work within 2 months, you are going to be paying a penalty of 20 cedis or 20 million. Okay, let me make it 20 million. 20 cedis is immaterial. So 20 million. We have signed a contract, and I'm saying that you should supply goods within 2 months. Okay, and included in the contract, we are saying that if you're not able to supply the goods within the 2 months, you are going to pay a penalty of 20 million. Okay, the question now is, the entity that is going to be supplying the goods have to determine, they have to reassess they have to determine to know whether they have the ability to supply all the goods within the 2 months or they don't have the ability. So the entity is saying that, okay, we cannot supply, all things being equal, we cannot supply all the goods within the 2 months. It means that the entity is now having a present obligation to settle what? 20 million or to pay 20 million to the supplier in the what? In the future or at the end of 2 months. What is bringing the 20 million? It is the contract that we have signed. That if you're not able to provide the goods within 2 months, you are going to be paying 20 million. So today you are saying that you cannot what? You cannot provide all the goods at the end of the 2 months. It means that you are going to pay the 20 million. Okay, so we have a present obligation to pay 20 million at the end of 2 months. So you have to recognize the liability now because the liability is arising now. It's arising now from the contract that we have signed. Okay, so the legal issue, if you don't pay that particular, the person can take action against you. The person can take legal action against you because a contract is something that we are going to be signing. So if you talk about the legal one, we are talking about the obligation is being posed to the entity either through legislations, either through contract that they have signed or other laws. Okay, we can have other legislative instruments or other laws that will also be posing what obligation on you. So the obligation can be through what legal means, which can be legislation, is being by legislation. Okay, is being by what legislation. A situation can be like, okay, the Environmental Protection Agency is saying that any entity that destroys more than 2,000 trees, okay, in a particular society, they have to pay a fine of 10,000. We have destroyed more than what? More than 2,000 trees, and we did not try to what? Try to replant them. It means that we are going to be paying them, we are going to be paying the what? The Environmental Protection Agency a fine of what? 2,000. Why? Because the law said this, and we have actually what? Fall a victim of the law. So we have to make provision for that. Okay. The provision, the present obligation might not be from a law, but might be from the past experience, must be from the what? The entity's own what? Policy. Okay, so the entity can have their own policy. So we have the policy of the entity or own policy, or it can also be from past experience. Okay, it can also be from past experience. Okay, so it can be from the past experience of the entity or can be from what? From the policy that is being, it is part of the policy of the entity that whenever something happens like this, we are going to be making provision. Okay, so what will happen now is that, okay, we have engaged or we are engaged in mining. Okay, we have engaged in mining. So we are saying that, okay, anytime the mining is done after, we normally restore the what? The land to its original place. No law is asking us to do that now, but it's part of our policy that, or we just want to be a responsible what? Corporate what? Citizens. So we are saying that whenever the mining is done, okay, we normally what? We normally bring the land to what? Its original what? Situation. Okay, that is our policy now. Okay, we have started the mining and we are saying that this cost will be incurred in what? In, let's say, 5 years' time. Okay, what will happen now is that there is a present obligation now because we have engaged in the mining and our policy is stating that whenever we engage in such activities, the land must be brought back to its original situation. So what we do is that we are going to be paying these amounts in 5 years' time. We ask ourselves, if we want to pay this amount now, how much are we going to be paying? So we recognize provision to the present value of the amount that we are going to be paying in the future because a present obligation is arising now. Why? How is it arising? It's arising because we have a policy and we have also engaged in the what? In the activity that is going to be making us what? To bring the land into what? Its original situation. So it can be constructive if the entity has its own policy of doing those things. Okay. We can also have issue of warranty. Okay. We can also have issue of warranty over here where we are going to be using constructive what? Constructive obligation. Okay. The entity is saying that whenever goods are being sold to the people, they have 1 year what? Warranty. Within 1 year, they can bring their goods to what? To them for what? For repairs. They can bring their goods for repairs. Okay. The entity is saying now that, okay, we have sold 10,000 goods and we are sure that 5% based on past experience, goods of this nature, 5% of it will always be returned. Okay, we now have a present obligation to perform warranty. How is the obligation coming in? We have a past experience that is bringing, or that is imposing that particular obligation on us. However, the past experience cannot just impose the obligation on us when goods are not sold. We only do the warranty on goods that are sold. Okay, as soon as we have sold goods, it means that we have the obligation now to repair 5% of the goods within the 1 month. So we have sold the goods, and the past experience is saying that we normally perform a warranty on these goods, and based on past experience, 5% of these goods will be returned. So it means that as soon as the goods have been sold, we now have present obligation to do warranty in the future. So because we have present obligation, we have to recognize liability. Or you can also say that the warranty will be done. Okay, the warranty will be done. Okay, the warranty will be done, or we just assume that those goods has been returned immediately, and we have we have repaired them. Okay, those goods have been returned immediately. The goods will be returned. Okay, the goods will be returned, but just that it will be returned in the future. But currently, we have an obligation to perform that particular one. Since we have an obligation, liability must be recognized. Okay, so the present obligation is very important because provision is a liability. So there should be a present obligation arising from past event. Past event doesn't mean that the thing should happen 10 years ago. Past event means that, okay, we have sold the thing on January 1. This is the end of the year. January and December are not the same. So January is now past, although it is within the same year. But January, if you want to talk about something in January now, it will be worse or when. That means that January was past. Okay, so it doesn't mean that the thing should arrive or the thing should happen maybe 10 years or 40 years ago. That's not a past event. If something happened on July and you are reporting your financial statements on December, July is the past. July is now in the past. Okay, that's what we mean by the past event. It doesn't mean that it should arise 10 years ago or not. Since the thing happened on 1st July, you are reporting on 30th July. 30th July and 1st July are not the same. 1st July is now past. So that particular obligation is coming in as a result of past events. We have an obligation at the reporting date to perform that particular one or to repair that particular goods. So that is arising from past event. Past event is 1st July, and we are doing this on 30th July. So past event doesn't mean that it should be 10 years ago. No. Okay. So there should be a present obligation arising from past events. Okay. We'll be looking at it very importantly. All right. The second one is that it should be probable. Okay. It should be probable that there will be an outflow of economic resources, or there will be an outflow of resources involving economic benefits. Okay, any of them. There will be an outflow of economic resources in settling the obligation, in settling. Okay, so there will be an outflow. The outflow might be in the future or might be in present. So it is probable that there will be future outflow of what? So let me just say future outflow. Okay, because the provision will always be settled in the future. There will be a future outflow. There will be future outflow of economic resources in settling the obligation. Okay. The outflow that we are talking about is you are going to be paying something. You are going to be using something to settle the obligation. That's what we are calling the outflow. Okay. You have actually bought someone's car. Okay. You are going to be repairing the car. So you have the present obligation to repair the car. But the question is, are you going to be paying something? You're not going to be paying anything. So if you are recognizing a liability in the books, how much are you going to be attaching to it? No amount. Okay, you are not going to be paying anything. So there's no way you should recognize a liability because you are not going to pay anything for the damage that you have caused. So you don't have any liability to settle. Okay, so there should be a probability that there will be an outflow of economic resources. Okay, you can destroy what? You can destroy the environment, or you can destroy the land of the community. You can destroy part of the what? Part of the forest of the community. But the question is, is there any law that is asking you to pay anything for that destruction? If there's law, is it possible that you are going to be paying any amount to settle that particular destruction? If no, then there's no liability because you're not going to be paying anything. We pay to settle liability. Okay, so the probability is also important. Okay, then the next one is that the amount, which can be the cost, or the amounts can be measured what reliably. The cost, okay, the amount, let me just say amount so that we move on. Okay, amount must be measured reliably. So there will be a reliable measurement of that particular amount. So the amount that we are going to be paying to settle, yeah, we are going to be paying 20,000 to settle. That is fine. We don't have to be doing anything to determine the amount that we are going to be paying. Okay. Okay, you have to know that before you can recognize provision, all these obligations must be what? Must be met. Why are we saying that it must be met? If you have a present obligation to settle, the question is, are you going to be paying any amount? You're not going to be paying any amount. So you're not owing anybody. You can't recognize the liability. Okay, if you are going to be paying any amount, do you know how much you are going to be paying? Okay, if you have the obligation, if you are going to be paying, okay, and there's a possibility that you are going to be paying, do you know how much you are going to be paying? If you don't know how much you are going to be paying, if you recognize the liability in the books, how much are you going to be attaching to it? If you recognize the provision now, how much are you going to be writing the provision just there and leave it? You have to what? You have to attach an amount to it. Okay, so if you have an obligation, it should be probable that you are going to be settling that obligation, and the amount that you are going to be paying to be settling that particular obligation should also be known. If that is the case, you can go ahead to recognize what? A provision. Okay, let's come to the probability of that particular amount. Okay, the probability of settling this particular one. Okay, probability of settling this. Okay, if you are determining the probability, okay, if you are determining whether it is probable to settle this particular liability, okay, you have to pay attention to a single estimate and also what we call the group. Okay, let me just mention a group estimate. Okay, or multiple estimate. Let me just say multiple estimate or group estimate. Okay, let's come here. If you want to know you are going to be paying any amount, this is what you are going to be doing. If I have sold 70,000 goods to you, okay, if I have sold 70,000 units of goods to you, and I'm saying there is a 2% chance that you are going to be returning the goods, what does it mean? There is a 2% chance that you are going to be returning the goods. What does it mean?
That means the goods will not be returned.
So it means I'm not going to be paying anything to what? To repair or to do whatever will be what I will be doing when the goods are returned, isn't it?
Yes, sir.
Okay. Or do I have a present obligation? How do I have a present obligation? I have sold to you, isn't it? So since I've
Yes.
sold to you, there's a possibility that you are going to return the goods. But the question is, will the goods be returned at all? There's a 2% chance that you are going to return the goods. It means that you're not going to return the goods. 98% chance that you're not going to return the goods. This is a single estimate. So if you are doing the estimate for an individual, the only time that you can recognize the liability is where it is very probable. Let's say there's a 70% chance that the person is going to be returning the goods. In that case, the person will return the goods. So I can recognize what? A liability, because I'm going to be paying something now for the return, for the return goods. Okay. If you are doing this, if I'm telling you that there's a 2% chance that you are going to be failing what? Financial reporting. It means that there's a 98% chance that you are going to be passing financial reporting. And it means that you will pass. So you will not fail. Okay. So if you are doing the estimate, if you are determining the probability, you consider single estimate and a group or multiple estimates. What do we call a single estimate? If you are selling to an individual customer, the only time that you can recognize liability or a provision is when there is a higher chance that the issue will happen. There's a 90% chance that you will return the goods. It means that the goods will be returned. So since I've sold to you and I have the policy of what carrying out repairs on any goods that have been sold to the customers, and there's a 90% chance that you are going to be returning the goods, it means that the goods has not been sold at all. The goods has not been sold at all. The goods has not been sold at all. So what will happen is that I have to record the cost of what repairs because I have a present obligation to what to repair those goods for you when they have been what when they have been returned. But let's come here to group. Assuming you have sold 70,000 units to a group of people. Okay, you have sold 70,000 units to a group of people. And we are saying that there is a 1% chance that the goods will be returned. Would there be any return? Would there be any goods returned in this particular place? Let's say we have sold to 100 people. Okay, we have sold to 100 people, and we are saying that there's a 1% chance that 1%, there is 1%, or there's a chance that 1% of the customers will return their goods. Would there be any goods returned in this case?
Yes, there will be.
Yeah, there will be, because whether 0.05, there will be somebody from these people that will return the goods, isn't it?
Yes, sir.
Okay, so for this one, you make the provision to what? To the number of the returns that will be made. Okay, so if you are doing this, you pay attention to what? To the you pay attention to the estimate, the probability. If it is for individual, you can only recognize a liability or provision when there's a higher chance. But if it is for a group of people or a group of items, okay, even if it is 0.05%, there will be a return because someone from the group will actually return the goods. So there will be a return. So you recognize provision based on what? The portion of the goods that will be returned. Okay, if you are coming to the cost of measuring reliably, so how do you measure the cost? Okay, how do you measure the cost? The reliable estimate. Okay, the reliable estimate. How do you determine the reliable estimate? Is very important. Okay, the reliable estimate is where you pick the best estimate. Okay, what do we call the best estimate? We'll be looking at that as the best estimate. What do we call the best estimate? Sometimes the question will be telling you that, okay, the entity is going to be paying the amount in 2 years' time. Okay, the entity is going to pay the amount in 2 years' time. The question is, if you have the cash to pay now, the amount that you are going to pay now, will it be the same in 2 years' time?
No, sir.
Okay, so there will always be an issue of what? Time value of money, financing components. So if you have been given cost of capital of the entity, you just ask yourself, if I should pay this amount now, how much am I going to be paying? So you find the present value where it is possible. So you use the present value and now unwind the amount over the 2 years period. So you can use present value. You can also use what we call expected values. Okay, expected value. Sometimes the question can give you issue and probabilities, mostly for multiple items or multiple estimates. So they can say that there is a 20% chance that 2,000 of the goods will be remain, or 2,000 will be remain. There's a 40% chance that 40,000 of the goods will be remain. There is a, let's say, 15% chance that, okay, 2,000 will be remain. Then you do this one. What you do is that you use expected values. Okay, we are saying that there's a 20% chance that 2,000 will be remain. So if 2,000 is remaining, okay, 20% of that will be what? So we use expected value 0.2 multiplied by 2,000 plus 0.4 multiplied by 4,000. We use expected values. We put the probability of all of them. What is the possibility of the thing happening over here? Okay, we find a probability on it. We put all of them together. We put all of them together. Then we go ahead with it. Okay, it's a very simple issue. Let's pick just a general question on this particular one. Then we look at specific applications. Okay, specific applications. Okay, it's a very simple one. And okay, so let's just pick some Okay, let's just pick this one example. Let's just pick those examples and see what we can do. Charles, are you there? First example. Let's just pick those small ones to
Yes,
broaden
sir.
our understanding and move on. Yeah.
Okay, so example 1, constructive obligation. A retailer store has a policy of refunding purchases by dissatisfied customers, even though it is under no legal obligation to do so. Its policy of making refunds is generally known. Should a provision be made at the end of the year? The policy is well known and creates a valid expectation.
Okay. I'm sure that is part of the answers to the question. So let's come here. Okay. Let's come here. Okay. Let's come here. Okay, this one they haven't given you any amount, isn't it? But you just have to use your professional judgment to determine whether a provision will be made or not. Okay. Whenever goods are being sold, okay, or do the entity have any form of what? Any form of legislation or any form of instrument which can be a published instrument for them that is presenting an obligation or that is imposing an obligation to them whenever goods are being sold.
Yes, please, their policy.
Okay, it is their policy of what? Of refunding what? Purchases by dissatisfied customers, isn't it?
Yes,
Okay.
sir.
So it means that currently they have a policy of doing that. So whenever goods are being sold, it means that they have an obligation of what? Paying the dissatisfied what? Customers, isn't it? Okay.
Yes, sir.
So let's come here. They don't have any legal obligation, but we know that provision can also be created through what? Constructive what? Obligation. So they have a constructive obligation now of doing this. Okay. The policy is what? They are saying the policy is what is generally known as well known. So no customer will be buying and say that he's not aware of that particular policy. The person is aware. So whenever the person is dissatisfied, the person will return the goods. Okay. So currently the entity has what? Has a present obligation as a result of what? The policy. So whenever goods are being sold, they have the obligation of what? Of refunding certain amount to those people. Okay. When goods are being sold, it is possible that part of the goods will be returned, isn't it?
Yes.
Okay. It is possible that some of the goods will be returned. And if those goods will be returned, there will be an outflow of economic resources to satisfy them, isn't it?
Oh, yes, sir.
Okay. Although you are not giving any figure over here, but you can just use your professional judgment to determine whether other provisions should be made or not. Okay. They have a policy of doing refunds. So it means that when the entity sold goods to what? Customers, it is possible that what? Part of the goods will be returned. And the entity is going to be paying a certain amount of money to what? To settle those things. So they have a present obligation as a result of the policy of what? Doing the refunds. Okay. When goods are being sold, it is possible that some of the goods will be what? Will be returned and the entity will be paying an amount to settle them. So it is probable that there will be a future outflow of economic resources in settling what? Settling the obligation as a result of the selling that they are going to be doing. Okay. At the time that the sales are being made, the entity will determine the what? The refunds. The entity will determine the refund. So a reliable estimate can be made for the refund. Okay, so they should make what? They should make provision because they have a present obligation. It is possible that when sales are being made, there will be a return of some goods and they are going to be paying an amount to determine or to settle that particular obligation. So you can also use the possible what situation, or you can use the recognition criteria to answer this question. They have a present obligation, although the goods has not been sold, but we just assume that the goods has been sold. Okay, we cannot have a liability when we are not committed to pay anything. We haven't sold goods to you, so there's no way you are going to return the goods and we are going to be paying you. Okay, so the sales will be made before we can have what? We can have an obligation to settle. If I haven't given anything to you, there's no way you return the thing that will pay you. So you assume that the sales has been made. If the sales has been made, the entity has a present obligation of what? Of paying those refunds because they have a policy that what states that employees should be what? Their customers should be refunded for any goods that have been returned for dissatisfaction. And when sales is being made, it is possible because it will be made to a group of people or a number of people. So it is possible that there will be a return and the entity is going to be paying cash to settle that. And the amount of the settlement can be determined also. Then they should recognize what? A provision. Very simple as that. Very simple as that. Okay. Very simple as that. Let's come to let's come to this example 2 here. Okay, let's come to this one.
Okay, so example 2, probable outflow. An entity sells goods with a warranty covering customers for the cost of repairs required within the first 12 months after purchase. Past experience suggests that 95% of goods sold will not require a warranty repair. Should a provision be made for warranty repairs?
Okay, let's come here. This one, are we having a group estimate or we are having a group estimate or we are going to be having individual or a single estimate?
A group estimate.
A group.
So because of we are selling to customers, isn't it?
Yes, sir.
Sure.
Okay. So if the goods has been sold to a group of customers, what will happen? There will be a situation where some of the customers will be returning their goods, isn't it? Okay.
Yes.
But what if we are selling to just one person? Would there be any repairs? Would there be any provision for repairs?
No, sir.
Because of the 90%, it means that the person will not return their goods, isn't it?
Yes, sir.
Okay. So this one, what you do is that you talk about the two situations. Okay. The two situations. Okay. You talk about the two situations.
Hello,
and then,
sir.
yes, yeah.
So, sir, are you saying because of the customer being mentioned here, the goods might not be returned? Because if you look at the past, the end sentence, past experience suggests that 95% of the goods will not require warranty repair. So in that situation,
5% will be.
Yes, 5% will be returned.
Okay, so if you are selling to a group of people, it means that some of the goods will actually be returned, isn't it?
Okay.
Okay, but if you are just selling to one person, okay, if you are just selling to one person, yeah.
So my question is, so because it's a group of customers,
yeah,
it means that the answer will be maybe yes.
Provision, yeah.
Okay, sir.
Okay, so if it is a multiple product, okay, if it is a multiple product that you are selling to one customer, if it is a multiple product that you are selling to a customer, and they are saying that there's a 5% there is a 5% chance that the goods will require a repair. It means that a customer you are selling multiple products, so some of the products can actually be returned also. Okay.
Okay, sir.
But if you're just selling a single product, if you are actually selling a single product and you are saying that 95% of there's a possibility that 95% of the goods will not require a repair, it means that the person might not be okay. Not the 95% is not talking about, let's get that one right. The 95% is not talking about the customer itself. It's talking about what? The goods, isn't it? Okay. The 95 is talking about the goods. So even if you are selling to a single customer, there's a possibility that the person will retain 5% of their goods for repair. Okay. So this particular 95% is not talking about a customer. It's talking about the goods that we are selling to the customer. Okay. So if we are selling 10,000 goods to the customer, it means that 95% of these goods will not require what? Repair. But 5% will be requiring repair. And the person will bring 5%. So we can actually make provision for that also, because this one is talking about the goods. But if we are making the provision on individual basis, like the customer itself, no provision should be recognized. But if you are doing it on group basis, then you can recognize provision because some of the items will actually be returned. Okay. So if each cell were considered individually, no provision would have been made, as there's only 1% probability of the goods being returned for what? For repair. If the goods are what? If each cell were considered what individually, no provision will be made as there is only 5% of the probability of the goods being what returned. So if we are considering individually, it means that we are considering the customers. We are selling to the people individually. Okay. However, if sales are considered as a whole, there's a likelihood of 5% being returned for repair. Therefore, a provision should be made for the expected cost of repairs to 5% of the goods in the last what? In the last 12 months. Okay, in the last 12 what? 12 months. Okay, let's come to reliable estimates. Okay, the reliable estimates, I've spoken about that one. The best estimate of likely outflow. There should be a prudent what estimate discounted when time value of money is what is material. I've spoken about that one already. Okay, I've spoken about that one already. Let's pick some of these questions and see. Tutorial question 1, then we look at the specific situations.
Okay, so tutorial question 1. An entity has a policy of only carrying out work to rectify damage caused to the environment when it is required by local law to do so. For several years, the entity has been operating an oil rig that causes such damage in a country that did not give legislation in place requiring any rectification. A new government has now been elected in that country and, at the reporting date, has just brought in legislation requiring rectification of environmental damage. The legislation will have retrospective effect required. Explain whether a provision should be recognized.
Okay, so that is it. They say the entity has a policy of only carrying out work to rectify damages caused to the environment when it is required by local law to do so. You can see that their policy is also based on what?
By law.
Okay, their policy is based on the law. So if there is no law, they are not going to implement their policy. Okay, for several years, the entity has been operating an oil ring that causes such damage in a country that did not have legislation in place requiring any rectification. A new government has now been elected in that country, and at the reporting date has just brought in legislations requiring rectification of environmental damage. The legislation will have retrospective effect. Explain whether a provision should be recognized. Looking at this one, what are we going to be saying here? Okay, when do we recognize provision?
When there is a legal obligation.
Obligation.
Okay. So subject that legal obligation to this one now.
Okay, sir.
Okay, is there any, from the scenario here, is there any legal obligation arising from this situation?
Yes. Yes.
Okay, it is coming in because of what?
The
There is
local
elected government with their
The law that will
obedience.
be applied retrospectively.
Okay, it means that the law will be applied from the time that the damage has been caused, isn't it?
Mm-hmm.
So we are now a victim of this particular law, and we have actually, you see, the law can be there, but if you don't fall a victim, there is no way you are going to be paying any amount to the authority. But you can see that we fall a victim for this particular law, isn't it? We have committed
Yes.
ourselves. So currently, we are going to be paying a certain amount of money to the authority for that particular one. Okay. If the authority are not coming with the amount, we can use our best estimate. We can use our management discretion to determine the amount that we think we are going to be paying. Okay, so what will happen is that as soon as there's a present obligation, you can actually make a reliable estimate. You can say that, okay, based on a past experience, we have been paying this amount, so it is likely that we'll pay this amount. If the new amount has been determined, then you can just go and write the excess or the reduction to the liability or whatever you are going to be doing. So you can see that currently there is a present obligation arising from past events. What is a past event? The entity has caused a lot of damages to that particular one in the past, isn't it? Okay, although they have a policy, they only carry out repairs on that particular situation when a law requires them to do that. Now a law has been published, a legislation has been published that is going to be having a retrospective effect. Retrospective means that it will be assumed that the law has been in existence from the time that the entity has done this. Okay, so what will happen now is that there's a law and they have to now carry out the what? The rectification because they have a policy of doing so when there is a law saying that. So they have an obligation now to carry out the rectification or the damage that has caused or that has been caused in the future. Okay. As far as there's a damage, what will happen? Are we going to be paying something to rectify this?
Yes, sir.
Yes, sir.
There will be an outflow of economic resources in settling this because the law cannot ask us, okay, we are not doing this in Ghana. Okay, in Ghana, we know nothing can happen, but we are not doing this in Ghana. Okay, we are doing this in an independent country where the system is working. Okay, so as far as you have an obligation, as far as the law is now saying that you have to carry out that rectification, it means that you are going to be spending a certain amount of money or you are going to be spending a certain amount of money to do this. So there will be an outflow of future economic resources to settle or to carry out that particular rectification. Okay, can the entity determine that particular amount? Yes, they can use their what? Their estimate or their discretion to determine this amount because the standard says that you should recognize the best estimate, the amount that you think you are going to be paying. So they should recognize what provision over here because the three criteria for recognizing what provision has been met. They have a present obligation as a result of the law that has been passed, and they also have a policy of carrying out the rectification work when there is a law requiring them to do so. A law has been passed now that is going to be having a retrospective what effect that is now requiring the entity to carry out that particular rectification. Okay. In their attempt of carrying the rectification work, they are going to be paying money. Okay. Even if we have the machines to do that, we are going to be buying for. Okay, so we are going to be buying for, or we are going to be employing other people or experts to do that particular rectification for us. So there will be an outflow of economic resources. It can be in cash, it can be in kind. So you can pay by giving the person asset, or you can pay by giving the person cash. So the estimate or the probability or the economic resource should not be cash. It can be any item at all. It can be done in cash. It can be done in kind. As far as we are going to be we are going to be paying a certain amount of money, the entity can actually carry out a best estimate of that one. So the amount can be measured or the cost can be measured reliably. The cost can be measured reliably. Let's take the tutorial one, then we'll move on to the specific situations. Tutorial two rather. Just.
Okay. So tutorial 2.
Yeah.
You are an accountant working for SZ, a manufacturer that provides warranties to its customers for all sales. Under the terms of the warranty, SZ undertakes to make good manufacturing defects that become apparent within 2 years from the date of sale. Based on past experience, it estimates that 8% of goods will be returned for repair within this 2 years period. A new managing director has recently been appointed, and he has asked you to explain to him why there is an expense in the statement of profit or loss relating to warranty claims that have not yet been received. Required. Prepare a briefing note for the managing director explaining, with reference to the recognition criteria of IAS 37, why an expense is required for future potential warranty repairs.
Okay. So you are the accountant. Okay. So what are you going to be saying?
Okay, so sir, you stated earlier on that when it comes to warranty provisions, when we are saying that there exists a present obligation, it doesn't necessarily mean that if they've not returned it, if they pretended, that's when we record. But if as a result of past operations, we see that all the time 8% of whatsoever we sell is being returned, then even though they've not returned it this time round, we should still make that provision that 8% of it will be returned. That's why we recognize that expense of warranty in the profit or loss.
Okay, so you have spoken about. I said you should do it in reference to what? To the recognition criteria of IAS 37. So it is important that you should state all of them and explain why. Use all of them to explain why you are having the provision in the books. Okay, so this is just a briefing note. So you can just write recognition criteria, how you prepare a note, a briefing note, a very simple note talking about the recognition criteria. Okay, When do we recognize a provision? When there's a present obligation, isn't it?
Yes, sir.
Yeah.
Arising from past events, isn't it? Okay.
Yes,
Yeah.
sir.
The question is saying that the managing director, uh, is concerned about what? Is concerned about why there's an expense in the statement of financial position. There's an expense in the there's an expense in the profit or loss relating to warranty that will be done in what? That will be done in 2 years' time. So it means that the entity has actually sold the goods during the year, isn't it? Okay.
Yes,
Goods
sir.
has
They
been
have.
sold during the year. Okay. Goods has been sold during the year. Okay. We have what? We have what? We have a policy of doing what? We have a
Settling
policy.
warranty claims.
Okay, we have a policy of carrying out these particular warranty claims. Okay, the goods can be returned, but then the question can tell you that they don't carry out repairs on this one. So go to the repairer over there. So it means that they don't have any obligation to do this. But as far as they have a policy of carrying out what warranty repairs to the workers or to the employees, it means that whenever the people return the goods, we are going to be doing it. So as soon as sales are being made, it means that we have committed ourselves to providing what? Warranty now. We have a present obligation to provide warranty for these particular customers. When are we having it? We are having it from the time that sales has been made. Okay, so you say that the recognition criteria, the following, or the IS-37 states that provision should be recognized when the following recognition criteria are being met. The first one is that there should be a present obligation, which can be arising from legal or constructive means, which will be relating to past events and anything that you are going to be saying there. Okay, then you come over here. Okay, there is existing what? There is the entity is having a present obligation from what? From a constructive what? Arrangement, because it is part of their policy to carry out what? To carry out repairs for every goods that are returned by what? By customers. Okay, they have the present obligation because the goods has been sold. So currently we have the obligation of what? Carrying out repairs on 80% of the goods that will be returned by customers. Okay, since we have a present obligation, we have to recognize a provision for that. Provision is just like, okay, the people have returned their goods now, but we don't have money to do it now. Okay, so we are saying that we are going to repair the goods in the what? In the future, which will be 2 years' time. So we pay the money in 2 years' time. Okay, that is the meaning of it. Because the people you have sold the goods to them. They will return the goods. It's just like you haven't sold the goods, or they return the goods today and you have what? You have actually repair the goods, but you are going to pay the person in 2 years' time. So you recognize the liability and you settle it in what? In 2 years' time. So we have a present obligation because we have a policy of doing this, and sales has actually been made. So as soon as the sales has been made, we have an obligation of carrying out repairs on 8% of the goods that will be what? That will be returned. Okay. Then we see that there's a probable that it is probable that there will be an outflow of future economic resources in settling the obligation, isn't it? Yes, since they will return the goods, we are going to be incurring a repair cost or a warranty cost to repair that particular goods. And this amount, since they are going to repair the goods, since it's based on past our experience, 8% of the goods will be returned, 8% will be returned, and we are going to be repairing that with money. So there will be an outflow of what? Resources. Okay. The amount that will be used to be measured reliably, isn't it?
Yes.
Yes, sir.
They are recognizing what? They are recognizing a provision. It means that they have actually estimated what? The amount that they are going to be spending. Okay, since they recognize a provision in their books, it means that a reliable estimate has been made of the amount that they are going to be paying. That is it. Okay, so you just talk to the finance director. Most of these people, they are not finance people. So they don't really, some of them, they are even finance people, but they don't really understand the standards, because some of us, if not for the professional exams, we don't even hear about these ones, because some of our lecturers, they are even lazy. So they will not teach you most of these standards. Okay. So just come and do the IS-12 and then the 16, the one that they can do, because they determine the content they are for you. Invested, they determine the content themselves. So that's what they do. So you just explain the recognition criteria for the person. They have a present obligation because of their policy, and currently there is a present obligation because goods has been sold. And based on past experience, 8% of the goods will be sold. So currently we have an obligation of what? Repairing 8% of the goods that have been sold today in the future. So we have a present obligation of carrying out that particular repairs. So we have to recognize a liability. Okay. It is probable that we are going to be paying a certain amount of money to settle or to repair the goods. Okay. That is why we are recognizing it. So we are certain that when the goods are being returned, we are going to be what? Repairing them, and we are going to be paying money, or we are going to be using economic resources to do that. A reliable estimate can be made. That is why we are recognizing a provision in the books, because we have reliably what? Estimated what? That particular amount. That is why we are recognizing that particular provision. Any other issue before we move on to specific provisions?
So, sir, the recognition criteria.
Yeah.
So that one is sufficient to answer this particular question.
Yes, please. Yes, please. Because
Okay.
you can. Why are you having a liability in the book? You are having a liability because the liability met the recognition criteria of a liability, isn't it?
Sure.
Yes. So if they talk about why you are recording this in the book, the recognition criteria will be the best way to answer that question. Because if you have assets in the books, why do you have assets? Because you have seen this as an asset. The entity has control over it. Future economic resources will be flowing to the entity. So that is why you are putting it there. So if they ask you, why do you have the asset in the books? You have to explain your answer using the recognition criteria. Okay, that is it. Let's look at what we call specific applications. Okay, specific.
Sorry, sir, before you continue.
Yeah.
So the note that will be sent to the managing director, are we supposed to follow a certain format?
For this one, they just say a briefing note. Okay.
Okay.
The briefing note, you can just write recognition criteria or why warranty claim has been recognized in the books. So you just explain. You have the topic. It's not like a report that you are writing. So you just write something something brief and give it to the person. Okay. So let's come to specific applications. Okay. We have two areas. Okay. 2 or 3 areas for this one. Okay. Then we recognize them, but the rest we don't recognize them. Okay. Specific application. The standard provides additional guidance on how to apply the rule to specific scenarios. Okay. The first one is future operating losses. Future operating losses. We are estimating that we are going to be making a loss of 10,000 in the future. Can we make provision for the loss?
No, sir.
Why?
Because operating losses can change, or in the future situations can change, which could make that operating loss we are estimating to be even an operating profit. We don't really know what will happen in the future, though.
Oh no, we are very certain about the loss. Okay. Okay, we are very certain that the loss will occur in the future. Okay, we are very certain that the loss will occur in the future. Yeah.
So with prudence concept in mind, I think we need to make provision for future operating losses.
The provision that we are talking about is a liability. Provision that we are mentioning over here is a liability, not expense.
Hello.
Okay. Yes.
Hello.
We shouldn't make, because it looks like an expectation than an obligation.
Okay.
Yeah, there is no present obligation. It is not arising from a past event. So
okay, not even a past event. Do you have a present obligation to be paying somebody to be settling a certain amount of money in the future? That would be the losses.
no.
We are not going to be paying anything. Okay, we don't have any obligation now to pay or to settle anything in the future. Okay, so operating losses or losses are expectation than what? Obligation. They don't present any present obligation. They don't have any present obligation. We recognize liability when there is a present obligation. This one is an operating losses. We are not going to be settling anybody in the future as a result of the loss. Okay, we don't have any present obligation to pay anything for the loss in the future. Okay, we don't have any present obligation to know the loss will occur in the future. So Charles' situation will come here. Okay, we don't have any, no, we don't have any present obligation to incur loss or to pay for the losses in the future. So operating losses are not recognized. No provision is made for operating losses. They do not meet the definition of a liability. They are an expectation rather than what? An obligation. Okay. The second issue over here is what we call onerous contracts. Okay. Onerous contracts. Onerous contracts are those contracts that the additional cost of fulfilling the contract or the cost of fulfilling the contract is higher than the benefit that you are going to be deriving from that particular contract. It's a very simple situation. So let's come here. Okay. Let's say that currently we are supplying goods to somebody and the price we are charging the person 200 Ghana cedis. Okay. Currently the cost price of this item is what? Let's say is 180. Okay. So we have supplied these particular people. We have supplied these particular people up to the end of the year, which is December, let's say 2021. We have supplied out to this one, December 2021. Okay. At the end of the year, at the end of the year, this is what we are having. At the end of the year, this is what we are having. The price is still the same, but we have estimated that, okay, we have estimated that the cost price of the cost price of this particular item will now be increasing by, this will now be increasing by 30. Okay. From next year, what will be the cost price of the item?
That's 210.
Okay, 210. So we have the price, the revenue that we are going to be getting will be 200 per unit, but the cost will now be what? 210. What are we having?
Loss of 10 cedis.
Okay, so whenever a contract is giving you this one, we call this particular contract onerous contract. Okay, a contract that the cost of what? Completing the contract is higher than the benefit that it will be given to you. Okay, let's come here. At the reporting date, what is happening here? Okay, if you are having such a contract, what are the things that you are going to be thinking about? You are going to be thinking about two things. If you have a contract that is from next year or from the beginning of January, you are now going to be incurring more cost to fulfill the contract than the amount that you are going to be receiving from the person. What are the two things that you'll be thinking about?
So you'll be thinking of whether to continue it or whether to terminate it now.
Okay.
And the cost involved in both instances.
So you think about continuing the contract or stopping the what? The contract, because the stopping or you think of to continue or to stop. Okay. This one, let's come here. A very serious situation. Okay, let's come here. At the what? At the reporting date, do you have any obligation of paying 10 cedis? Do you have any obligation of paying 10 cedis? Do you have any present obligation of paying 10 cedis in the future or from next year?
Yes.
Yes, sir.
Okay, you have the present obligation because you are still with a contract. You are going to be continuing with a contract. So you have a present obligation that will be making you to pay 10 cedis per unit in the future. So you have a present obligation of what? Paying this particular 10 cedi in the future. Okay, so you can recognize a provision for this one, which we call the onerous contract. But we are talking about two situations here. You are saying that you either continue the contract or you either terminate what? The contract. Okay, let's come here. So let's say that you have 1,000 units remaining to supply. Okay, so at the reporting date, you have a present obligation of spending what? 10,000 in the future. Okay, so the additional cost, you look at the additional cost that you are going to be incurring. Why do we say additional cost? Because part of the cost will be covered by the amount that you are receiving. So additional cost is 10 cedi. So we have 10 cedi multiplied by the units that are remaining. You have a present obligation of buying these units in the what? In the future. So we have this particular additional cost meets what? The recognition criteria for liability, because you have a present obligation now from the contract that you have signed. So you have to continue with the contract. Continue with the contract means that you have a present obligation of buying that particular item in the future. The amount can be determined reliably, and you'll be paying a certain amount of money to buy that particular item to fulfill the obligation. Okay. Then this will now be giving you 10,000 Ghana cedis. Okay. Let's assume that you want to terminate this particular. So termination fee is what? Is 11,000. At the reporting date, what are you going to be doing? Will you decide on continuing or you decide on terminating? Let's base it on only quantitative measures. Are you going to be continuing or you are going to be terminating?
Continue.
Continuing. As a rational person, you are going to be continuing. So the standard says that you have a present obligation of incurring this 10,000 in the future. So when there's an onerous contract, how do you determine it's an onerous contract? The cost of fulfilling the contract is higher than the benefit that you are going to be getting. Okay, that's what we call the onerous contract. So if there is an issue like that, you just need to ask yourself, what is the cost of me fulfilling this particular contract? What is the additional cost of me fulfilling this particular contract? What is the amount that I'm going to be incurring? What is the amount that I'm going to be incurring if I want to I want out. Okay, so the question can give you the termination fee to be 9,000. You have a present obligation of paying that particular termination fee in the future, maybe in 2 months time or 3 months time, because this particular termination is related to a contract that is currently that we are having. So this particular termination fee is arising from a contract that we have currently. So we have a present obligation to fulfill this. We are saying that provision is just like, okay, you have terminated a contract today, but you are here to pay the person. So since you have terminated a contract today, what will happen is that you have to pay, but you are not paying, so you are owing. So you are accruing this particular amount into 2 months' time. So you recognize provision. How do you recognize provision? Provision will be treated as an expense. So you debit profit or loss with the 9,000 as provision. If you are going for termination, then you credit provision, which is a liability to the termination. So if you are moving the person amount, 9,000 as termination fee. So liability in all provision in all cases are treated as As treated as expense. Okay. But we have restructuring. Yes, please.
You finish with that, then I'll come.
Okay. But we have situation where the provision will be relating to assets. In that case, we don't expense the provision, but we add it to the initial cost of the asset, the one that we call dismantling cost, as if you come to assets. But in all cases, aside for dismantling or decommissioning costs, all provisions are treated as Are treated as an expense because they are liabilities. If they are liability, what will be their corresponding entry? The corresponding entry will be debit profit or loss. Debit profit or loss. Okay. Let's pick one question on the onerous contract. Okay. This one.
Please, let me come in before we move there.
Okay.
You were talking of the quantitative. This is a quantitative aspect. Out of in a qualitative side, whereby the person is thinking of his loyalty and loyalty to the customer. That when they stop the contract or when they terminate the contract, though the penalty attached is lower than the extra cost of fulfilling the contract, but he's thinking of his loyalty to the party, the other party.
Okay. If you are talking about loyalty will not come in here because whatever we are doing over here is based on figures. But if there will be any other cost that will be coming in from the loyalty, that will be a benefit to us, then we can factor in and pick the lowest one. Okay. The standard says that the provision should be made on lower of the present value of fulfilling the contract and also any termination fee. So since you are providing or since you are reporting in accordance with IS 37, you have to apply what the standard is saying. Okay.
Okay.
All right. I have one question here. Okay, you haven't solved. Okay, question number 19. Okay, I haven't solved this one before, so Let's try this one.
Okay, so question number 19. FBL has decided to close one of its overseas branches. The operations of the branch are to be moved to another country from June 2021, but the lease on the present building of the branch is non-cancelable and runs for another 2 years until 31st May 2023. The annual rent of the building was 150,000 Ghana cedis, payable in arrears on 31st May, but the lessor has offered to take a single payment of 210,000 Ghana cedis on 1st June 2021 to settle the outstanding amount owing and terminate the lease on this date. FBL has additionally obtained permission to sublet the building at a yearly rental of 70,000 Ghana cedis, payable in advance on 1st June 2021, and 60,000 Ghana cedis on 1st June 2022, if an external condition, into brackets, with 40% chance is met. The company needs advice on how to treat the above under IAS 37 provisions, contingent liabilities and contingent assets. A discount rate of 10% should be used where necessary. Required. Recommend appropriate accounting treatment for the above for the year ended 31st May 2021.
Okay, so this particular question is relating to what? Can you see the onerous contract? Can you spot any side that will be relating to onerous contract? Yeah, seniors, can we spot any side in this particular question that will open your mind to what? Onerous contract?
Yes.
Okay. The company is now closing one of 8 overseas branches, isn't it? They are currently having a lease on the what? They have leased a particular, or they have leased an asset that they are using for that particular branch now. Okay. Since you are closing down the what? You are closing down the branch, it doesn't mean that you have to stop. You still have to pay for the leases up to the end of the lease period. Okay. Now, the lessor is asking them to pay how much?
210,000.
110,000.
Okay. But how much are we paying? We are going to be paying 150 for the next 2 years, isn't it?
Yes.
Okay. What we do now is that we have to ask ourselves, okay, you can see that this 150 is including time value of money, isn't it?
Yes, sir.
Yes.
Okay. Assuming we want to pay, so that since we are not going to be using the asset for the next 2 years, it means that if you want to pay any amount now, we have to pay the amount excluding the interest that the person will be charging, isn't it?
Yes.
Okay. So what we do is that okay, if you count to onerous contract, let me just make it very simple. Okay. What it means that any amount that we are going to be paying, let me continue with this one. Okay, we are paying the 150 in the next 2 years. So the 150, the first 150 will be paid a year from now. This one will be paid 2 years from now. Since we are not going to be using the assets, if you want to take any amount from us now, it will be relating to only the principal payment, because we are not going to be using the assets, so you cannot charge. If you want to be fair to us, you can only take the principal payment relating to what? To the lease without interest. But you are asking us to pay 210. Okay, the question now is, if we want to pay now, the 150 we are paying it in what? In 2 years' time. One will be paid in a year time and another one will be paid. Okay, if we have cash to pay now, how much are we going to be paying? So just find the present value of you fulfilling the contract and any termination that you are looking for, any termination that you are going to be paying. Okay, that is what you do for the onerous contract. If you are looking for onerous contract, look at the cost, the present value of the cost that you are going to be incurring to fulfill the contract, and the present value of the termination. The termination is now in present value, so our payment should also be in present value. Okay, let me pick that particular side for you. For onerous contract, find the present value of the cost of fulfilling the contract, and you also find the present value of any termination fee. Let me take you to that side. Okay, come here. Onerous contract. An onerous contract is a contract in which unavoidable cost of meeting the obligation under the contract exceed the economic benefit expected to be received under it. A provision is required for the least net cost of exiting the contract, which is the lower of the cost of fulfilling the contract, any compensation or benefits, any compensation or penalties payable for failing to fulfill the contract. So we look at the cost of fulfilling the contract. Currently, the termination that we are paying is 210. That is the present value. So let's also present value the what? The cost that we are going to be incurring to fulfill such contract. Okay. So what you are going to be telling these people is that question number 17, right?
Number 19.
Okay, question number 19. So we have question number 19, FBL. Okay, so what you do is that the lease arrangement, okay, so you always start with English, okay, but if they ask you for computation, then you can just, but if they ask you for advice, you always tell them about how the thing will be treated, but don't write plenty English, okay. The lease arrangement, okay, presents, the lease arrangement presents what? Onerous contract. Okay, onerous contract. Under IS what? 37, provisions, contingent asset, and this one. Okay. So you can say that the IS 37 states that provision should be made. Provision should be made in relation to onerous contracts as the least cost of what? The least cost of either fulfilling the contract or what? Or terminating the contract, isn't it? Okay,
Yeah.
what I've written, you can also write it in a very different way. Okay, you can just, how you understand it, just state it. Okay, so the entity should recognize a provision. Okay, should recognize. Please don't go and be saying, don't go and be talking about the recognition criteria for provision. Okay, we assume that that has already been met. So the entity should recognize what? A provision, a provision as the present value of the cost of fulfilling the contract, present value of the cost of fulfilling the contract or terminating what? The contract. This will give you, the question will give you like, let's say 5 marks. Okay. And the 5 marks, if you want to do extracts and do things, you see that it will be like 2 or 4 entries that you are going to be passing. So they can't give you 5 marks for what? For just 3 or 2 entries. So you have to speak some English to take like 2 marks for the English. Then you take like 3 marks for the entries that you are going to be passing as well. Okay. So let me just go there and pick that. Okay. So they should make a provision of that. So the termination, the present value of the termination is what? The present value of termination cost is 210,000, isn't it?
Correct, yeah.
Okay. So present value of cost of fulfilling is what? So what we do is we use the time value of money there, isn't it?
Yeah.
Okay. So that will be like normal leases that we are going to be doing. Okay. So what will happen over here is, okay, let me just do this one in brackets. Okay. Okay, let me just see present values. So let me put a present value at the top. Okay. Present values. So we have termination there. Okay. Then we come to our, okay, so we have the termination cost. Termination cost. Then we have the cost of fulfilling. Cost of fulfilling this one. So this one, what we do is that we are going to be paying the 150,000 for 2 years, isn't it? So one will be done at the end of May 2022. The second one will be done at the end of May 2023, isn't it? So this 150,000. Okay. The discount factor is 10%, isn't it? Okay. So what you can do is that you can do your normal present value one, years over this one. But this is what? This is equal amount that we are going to be paying. So this will be annuity, isn't it?
Yeah,
Okay. And this will be paid for 2 years, isn't it?
that's correct.
So you calculate annuity factor for 10% for 2 years. What are we getting? Annuity 10
1.74.
1.74
.74.
multiplied by what? 150,000, isn't it?
Yes, sir.
What are we having?
261,000.
261.
Thousand.
Okay. So provision will now be made for what?
So 210,000.
So it means that we should pay the 210,000 now, isn't it?
Yes, sir. We should terminate it.
Okay, so we should terminate it. Okay, this particular question is not telling you that the entity still. So let me look at the kind of lease that they are talking about. Okay. Let me talk about if it is a finance lease, you will see that the company will still have what? They will still have the the lease liability in the books, isn't it? Okay. So entity has decided to close one of its branches. The operations of the branch are to be moved to another country from June 2025, but the lease on the present building of the branch is not cancelable and runs for another 2 years until 31 May 2015. Okay, so this one we just assume that the lease is what is an operating lease. Are you okay? So if it is a finance lease, there will be the lease liability will be in the books of the entity. The right of use will be in the books of the entity. So what we do is that we have to go and what? And remove the two. So we remove the lease liability now and replace it with what? 210. And we also remove the right of use because we are not going to be using the asset again. If that is the case, the accounting treatment will be different. But since they are saying that this will be accounted for under 37, then we assume that the lease is what? Is an operating lease where the entity is not recognizing any lease liability and they are not recognizing any right of use. So what we do over here is that we make provision to the lowest of this amount. So what will happen is that the FBL should make or should recognize a provision because we have a present value of paying this. Okay, we have the question didn't say we are paid this now. So she recognize a provision of 210,000 in each financial statement. So we are going to be looking at how this will be done in each financial statement. So in each financial statements. So what we do over here is that in each financial statement, we are going to be having If you are doing statement of profit or loss, we bring a provision over here as an expense because we are going to be paying that amount. That is a cost to us. So we have 210 as an expense. You go to statement of financial position, you have, it can depend on how or when you are going to be paying this amount. Okay, when you are going to be paying this amount. If they have paid the amount immediately, the corresponding entry will be what? Credit cash. But we assume that this has not been paid. And let's say this will be paid within what? Let's say 3 months or 2 months. So that will be a current liability. That will be a current liability. Okay. And the current liability will be the 210,000. So this is how we go about it. A very simple exercise. A very simple exercise. Okay. A very simple exercise. Okay. Now that portion is not what? It's not possible. Okay. That portion is not possible. FB has additionally obtained permission to sublet the building at yearly rental of 70,000 payable in advance on 1st January 2021 and 60,000 on June 2022. Okay. If an external condition with 40% chance is what is met. So there is a 60% chance that they are not going to be meeting what? The condition, isn't it?
Yes, sir. 60%.
There's a 60% chance that they are not going to be meeting the what? The condition. Okay. So since since they are not going to be meeting this one, it means that no amount will be what? Will be coming. They are not going to be subleasing what? The branch or the building. Okay. But since I haven't paid attention to that, but since you have not taken my mind to that particular place, let's assume if this particular condition would have been met or the condition for or the chance of making this one was 60%, which means that they are going to be leasing it. This is what will happen. Okay, this is what will happen. What you do is this. Okay. How are we paying the rentals? The rentals will be paid, the first 150,000 will be paid on 31 May 2022. Do you agree? And the second will be paid on 31 May 2023. Do you agree with that?
Yes, sir.
Okay. And the present value is what? Is 261,000, isn't it? Okay. If we are subleasing, what will happen? If we are subleasing, we are going to be receiving rentals from the what? From the third party, which will also be reducing the amount that we are going to be paying to the original lessor, isn't it?
Yes, sir.
Okay. So this is what you are going to be doing. You look at the cost of what it means is that you are going to be paying, you are still going to be paying the 150 to the original lessor. Okay, but the original lessor is saying that since you are not going to be using it, you can give it to somebody. That person will not pay to the original lessor. That person will pay to you. Then you pay the original amount to the original lessor. So you come to the cost of fulfilling that particular contract, which is the 261,000. Okay, you are going to be having 261,000 here, but this will be reducing by the amount that you are going to be receiving from that person. Let's come here. Let's come from the amount that will be coming from the sublease. Okay, the person is paying, the third party is paying what? 70,000 immediately, isn't it? Okay, so the present value of 70,000 is still 70,000, isn't it? Okay, so this you'll be having the addition of those two amounts. So the person will pay 70,000 now. The present value is the same thing. But the person will now pay additional what? 60,000 in a year time, isn't it? Okay, so the present value of that will be 0.909 multiplied by 60,000. Do you agree on the discount factor of that particular one?
Yeah.
Okay. What will be the amount that you are going to be receiving from the second person?
So in all, 124,540.
124,540. Okay. So you'll be receiving 124,540, isn't it? Okay. These amounts, it will be coming to you, isn't it? It's an income to you. So it will be reducing the amount that you are paying to what? To that particular person. So you subtract it. Okay, then you now take the actual amount that you'll be paying to what? You'll be paying to the lessor. Okay, how much are you taking there?
So 136460.
136
460.
460. So what are you going to be doing? You make provision for only what? Only in the 136, because if you are going for the 136, it's going to be giving you more money than what you are going to be paying 136 460 if the sub lease is what is allowed. The sub lease, the person will pay to you. So we can say that in the second year you are only paying 90,000. Can we say that the amount that you are paying a year from now, the first year of the 150,000, you are only paying 90,000?
Yes, sir.
The lessor, because the person that you are leasing the asset to, the person will give you 60,000. So you add 90,000 to that and pay the lessor. So if that condition is met, what will happen is that you have to now subtract the benefit that you'll be getting from the third party, where will be the sublease, from the amount that you are going to be paying to the original lessor. Then you now compare the cost of fulfilling, the net cost of fulfilling, and the termination cost. Then you pick this one. But they say that particular chance is having
60%.
40% of fulfilling it, so 60% of not fulfilling. So you cannot do that. Okay, Auntie Mefa, I hope you're okay with that one now. Okay, thank you for.
Excuse me, sir.
All right.
What if it was a 60% chance of fulfilling?
And that is what we have done, a 60% chance. 60% chance means that you are going to be fulfilling it, and you are going to be. This is a single transaction. Okay, so we don't do any estimation there. This is a single performance. Okay, single performance, we pick the highest one. All right. Let's come to the issue of what we call restructuring. Okay, if an entity is going to close down an operation, or they are going to be closing down a branch, it is likely possible that some people will be laid off and the entity is going to be paying them, isn't it? Okay.
Yes, sir.
So if entity is coming to carry out what we call a restructuring exercise, the entity is now going to be incurring certain costs from that particular arrangement. If your organization now decides to close down your operations, they have made a decision now to close down your branch. Okay, your branch, they have made a decision to close down that one now. They are committed to the plan of carrying out the operation. They have committed the decision to you people, and they have all the necessary things that it takes to carry out that particular restructuring, or that particular closure of the department. Currently, since they are committed to that one, it means that they have the obligation of carrying out the restructuring, whether in the future or whenever they are going to be doing it. And they are going to be incurring certain costs that are directly attributable to the restructuring. The first cost will be the redundancy cost. Some of the employees will be laid off and they are going to be paid. Okay, so if the entity, we are looking at the situation of restructuring. Okay, the restructuring is just a management decision to carry out or to reduce the workforce, or to close down, let's say, a particular division, or a non-profit making division, or a segment. If that is being done, some people will be laid off, some costs will be incurred. Okay, let's come here. The management is saying that they are going to be doing the restructuring in 2 months' time. Okay, what it means is that in this 2 month time, they have a plan how the restructuring will be done from A to B. They have a plan on that one, so they have a detailed plan. Okay, what we mean is that they have a detailed plan. Okay, the plan has been communicated to all the people that will be affected. So the plan has been communicated. The plan has been communicated to all the people that are going to be involved. So if you are talking about all the people that will be involved, we are talking about the employees, the suppliers, and the customers. Okay, and the entity is also committed to the plan. Okay, the entity is also committed to the plan. Okay, what it means that the restructuring will be done. If all these things are in place, it means that the restructuring is possible, isn't it? the restructuring is highly possible. Is that the case?
Yes, sir, that's the case.
Okay, it means that a restructuring is going to be highly possible in 2 months' time. If this particular restructuring is highly possible, it means that the entity has obligation to now carry out the restructuring as at the day that the decision has been made, isn't it?
Yes, sir.
Okay, we have a present obligation of carrying this one. Okay, would this particular restructuring brings in certain costs? Okay, what are those costs that are directly attributable to the restructuring? What are those costs that we are only going to be incurring them when we are doing the restructuring? There will be some certain costs that whether the restructuring is done or not, they will be incurred. Example is the cost of relocating staff. So they will say that the cost of transferring staff from the closed division to what? So other division. Even if we are not doing restructuring, there will be a transfer of a staff from one division to other. So that is an activity that is associated with the continuing business activity of the entity. What are those costs that are not related to the what? To the continuous activities of the organization? They are only relating to the restructuring. Okay, let's come to this one. Assuming the entity has a detailed plan, okay, but the plan has not been communicated to the employees, and the operation is still going on there on that particular division or that particular plant. Does it mean that the entity is going to be doing the restructuring right anytime soon?
Not anytime soon, sir.
Okay. So you always have to look at if the restructuring is done, okay, there is a cost that will be associated, but we have to determine the probability of the restructuring. Is the restructuring possible? How do we say, or when do we say the restructuring is possible? When the entity has a detailed plan. Okay, that detailed plan is that they are having a plan on how the restructuring will be done. Which side they are going to be closing down, which side they are going to be closing down first, which one will be done. Okay, this particular plan has been communicated. If the plan has been communicated to it, means that we are now saying that you should be looking for what? You should be looking for different organizations or different job opportunities. And they are committed to the plan that nothing is going to be changing them to what? From carrying out the plan. Or sometimes the entity will not have any plan, they will not have anything, but they will start implementing the plan. It means that they have started carrying out the restructuring already. So they have an obligation. They are going to be incurring a cost. Since they have started, they are going to be incurring a cost. We make a provision for that. Okay. But sometimes they can also give you a situation where the entity will have a detailed plan, but operations will still be ongoing on that particular facility, and the plan will not be communicated to the employees. What it means is that the people, they are just showing off. They are just saying that the restructuring will not be done. Okay, the restructuring will not be done. The possibility of carrying out the restructuring is very low. So we don't make provision for anything. We don't have any present obligation to carry out that particular restructuring in the future because the possibility of it being carried out is very low. So it will not be done. In that case, the entity will not be making any provision. But if all the recognition or all the conditions of carrying out the restructuring or the possibility of carrying out the restructuring is very high, the entity shall make provision based on the present obligation of carrying out that particular restructuring. And this particular provision should be dealing with costs that are not associated with the ongoing activities of the entity. An example is the redundancy redundancy costs. Okay, the costs that we are going to be paying to the staff, those that are going to be laid off. If not for the restructuring, we are not going to be sacking anybody. Nobody will be laid off. People will be continuing their activities. There can also be some penalties relating to contracts that we are going to be canceling because of the restructuring. If it's not because of the restructuring, it is not possible that we are going to be canceling that particular contract. It can be termination of lease that the entity is going to be paying for. But any cost associated, any cost that is incurred, that is associated with the ongoing business activities of the entity, any cost associated with the ongoing or the continuous operations of the entity should not be provided for, because those particular costs, whether we are carrying out the restructuring or not, they will still be incurred. If you are transferring machines from one division to another, even if we are not doing restructuring, the machines will still be transferred. We transfer machines from one division to another. So even if there's no restructuring, there will be that transfer of machines. Okay. Transferring staff, relocating staff from one division to other. Even if we are not doing restructuring, there will be a transfer of what? Staffs. So those costs that are relating to the ongoing activities of the organization, we don't what? We don't recognize provision on them. Okay, let me pick that one. Yeah, Sinafred, your one is up.
Yeah, so sir, how about, there are some companies that normally make provision for severance already, whether they are anticipating restructuring or not. How about that? Because at the end of every month, they will make the severance provision, and then whether they are anticipating to do restructuring or they will still do it. So how about that?
Okay, restructuring is about we closing down a particular division, or maybe we can be management restructuring, but in most cases, it's going to be reducing the operations of the entity. Okay, if you are reducing the operations of the entity, it means that some of the staff will no longer be there. But if they are not carrying out any restructuring, thereby reducing any provision, but they are anticipating that some of the staff are going to be doing something and they will sack them, isn't it? So that particular one that they are doing over here, it means that they are thinking that they are going to be terminating the normal termination of the what? Of the employment or the appointment of that particular staff or some number of staff. And that is going to be based on their what? Their past experience. Okay, if they are doing that on their past experience, that is fine. Okay, so whenever we employ people, normally people will work for 2 years, then they will go. Okay, then we pay them this amount of money. So if that is part of your past experience and you are saying that it is possible that 2% or there will be a labor turnover of 2%, and we are going to be paying them this amount, that is fine. Okay, that is fine. That is not mainly restructuring. No, restructuring, we are talking about major issue where there will be a division that will be closed down, or part of the operations of the entity will be closed down.
And another one, I know of an organization that recently did move from one model that is from permanent employment to, say, contract. In that situation, they kind of made everybody redundant and then recruit the people again on contract basis. That one, nobody was actually, fired, I should say, for lack of
And
better word.
they haven't been paid any amount, isn't it?
And they were paid. They were all paid their redundancy packages, and then they gave them contracts.
Okay, so that one, the amount that they have been paid will be charged as what? As a cost, because they have already paid. Okay.
Okay.
So it will be charged as an expense. Okay. But if they have made announcement that they are going to be doing that, okay, and they are going to be paying those people a redundancy fee that is going to be separate from their normal costs that they are going to be taking. Okay, if that will be done, if they have a commitment of changing the employment package, it just means that you are laying those people off and now taking them back on a different situation, or the organization is starting afresh again. So if they have made the intention known to those people, and they are saying that they will be paid a certain amount of money for this particular arrangement or for the cancellation of that, they can actually make provision for that. And if the time comes, they will pay. The amount that they will be paying will still be treated as an expense. But this one they have paid already. So since they have paid,
yeah, they were actually informed in advance that
okay, so
at
they
this
can make
period.
provision for that.
Yeah. Okay.
They can make
Thank you.
provision for that. Yeah. Okay. Let's come to a provision can only be made if the entity has a detailed formal plan and has raised a valid expectation in those affected, and to carry out a restructuring by starting to implementing it or announcing it. Okay. So we have said these ones already. Provision can then only be made for costs that are necessarily entailed by the restructuring. Okay, not associated with the ongoing activities of the entity. Okay, costs specifically not allowed include retraining, relocation of existing staff, marketing and investment in new systems. Costs that are associated with what? with the ongoing activities. You can see that if the entity should be retransferring, if they should be transferring those particular staff, you see that they are not going to be terminating their original contracts. Okay, they will still be on the new contract, but just that you go and work in a different place. So that is not, we are not terminating your appointment. We are not laying you off. Okay, so relocating you is not what is not part of the cost that we are incurring to carry out the restructuring. So we use only those costs that are necessarily incurred or they are necessarily relating to the restructuring, and costs that are not associated to what? Associated with the continual or the ongoing activities of the organization. Let's pick a typical example of that, and let's see. Okay, let's come to Charles. Can you take the question number 17 for us? Charles, are you there? Okay. Auntie Rebecca, are you there?
I'm taking it, please.
Okay.
Question 17. At 30th June 20x8, Abu had a plan to sell its 80% subsidiary, New War. This plan has been approved by the board and reported in the media. It is expected that Old Castle, an entity which currently owns the other 20% of New War, will acquire the 80% equity interest. The sale is expected to be complete by December 20x8. New World is expected to have substantial trading losses in the period up to the sale. The accountant of Abu wishes to show New World as held for sale in the consolidated financial statement and to create a restructuring provision to include the expected cost of disposal and future trading losses. The CEO does not wish New World to be disclosed as held for sale, nor to provide for the expected loss. The CEO is concerned as to how this may affect the sales price and will almost certainly mean bonus targets will not be met. The CEO has argued that they have a duty to secure a high sales price to maximize the return for shareholders of Abu. She has also implied that the accountant may lose his job if he were to put such a provision in the financial statement. The expected costs from the sale are as follows: the future trading losses, various legal costs of sales, redundancy costs of new employees, impairment loss on own assets. Included within the future trading losses is an early termination penalty of 6 million cedis for a lease asset which is deemed surplus to requirements. I'll discuss the accounting treatment which Abu should adopt to address each of the issues above for the consolidated financial statements.
They are saying that at 30th June, Abu had a plan to sell its 30% subsidiary, which is the New War. This plan has been approved by the board and reported in the media. It is expected that the Old Castle, an entity which currently owns other 20% of New War, will acquire the 80% equity interest. The sale is expected to complete by 31 December 2S8. New World is expected to have a substantial trading losses in the period up to the sale. The accountant of Abu wishes to show New World as held for sale in the consolidated statement and to create a restructuring provision to include the expected cost of disposal and future trading losses. Okay, the COO does not wish New World to be disclosed as held for sale, or not to provide for the expected what? Losses. Okay. The COO is concerned as how this may affect the sales price and will almost certainly mean bonus targets will not be what? Will not be met. The CEO has argued that they have a duty to secure a higher sales price to maximize the return on what? The return for shareholders of what? Of Ababo. She has also implied that the accountant may lose his job if we are to put such a provision in the statement. The expected costs from the sale are as follows. Okay, we have the future trading losses, various legal costs of sale, redundancy costs for new world employees, impairment losses on own assets. Included within the future trading losses is an early termination penalty of 6 million for a lease asset, which is deemed surplus to what? Two requirements. Discuss the accounting treatment which Aboabo should adopt to address each of the issues above for the consolidated what? Financial statements. Okay. How do we go about this? Okay, they are saying that the entity has a plan to sell what? They have the plan to sell the subsidiary, isn't it?
Yes, sir.
Okay,
Yes,
if
yes.
you have the plan to sell the subsidiary and this has been approved by the board and this has been reported in the media, isn't it? It means that decision has been made, activities to what? To allocate what? A buyer, a potential buyer is what? Is committed or is initiated, and people are also committed to what? To the sale. So since this is a subsidiary, okay, this is a subsidiary that we want to sell, okay. If you sell the subsidiary, it means that we are not going to be operating on that particular subsidiary, okay. But the issue is this particular subsidiary purchased to what? To be sold? Is it necessary for sale? Is it necessary for sale? Are we selling the subsidiary in a different what location? If that is the case, then we either classify it as a head for sale or a discontinued operation. Why are we calling it a discontinued operation? Because if you classify it as head for sale, we are not going to be operating there again. Okay, so the subsidiary, the company which is Aboabo Limited should classify the subsidiary as what? As head for sale, which will be the lower of the recoverable amount, which is the net realizable value, or the what? The carrying value of what? Of the subsidiary. Okay, because the decision or the criteria for recognizing this particular asset as head for sale or discontinued operation has been met because they plan to sell it 80%. So if they plan to sell it, what will happen? You can see that this is not what? This is not a loss of control. They are selling what? Entirely all the what? All the subsidiary. They are selling all their shares in the subsidiary. So that's a total disposal. Okay, that's a total disposal. So what will happen is that the subsidiary to be classified as head for sale, where the legal cost of sale will be what? What are we going to be doing with the legal cost of sale? It will be subtracted from the what? From the fair value, isn't it? This will be the cost to sell. The legal cost of sale is just the cost that we are going to be incurring if we want to sell the what? The subsidiary. So this will be treated as cost to sell. That will be subtracted from the fair value. Okay. So the first thing is that the IFRS 5 says that entity can only classify an asset as head for sale when they have made a decision to sell and they have what? They have also start what? Advertising the asset for sale, or they are committed to the plan to sell. They are not saying that they are not going to be selling. They are going to be selling it. Okay, so the subsidiary should be classified as what? As head for sale or a discontinued operation at the time that the decision is being made. How do we classify it? It will be the lower of the carrying value or the net realizable value. Okay, that is it. The head for sale should be down there. The head for sale should be down there. Okay, they are saying that if they sell the subsidiary, it is possible that the existing employees will do what? What will happen to the existing employees? The new owners will do what? They will sack them, isn't it? If they sell, some of the subsidiaries will be out of employment, isn't it? When the
Yeah.
sale
Yes,
is
sir.
done, some of the employees will be out of what?
Work.
Okay. And so we should make a provision for restructuring of what?
5 million,
5
please.
5 million for redundancy.
Okay, let's come here. Included within the future operating losses is an early termination penalty of 6 million for lease asset, which is deemed surplus to requirements. Why are we terminating this particular lease?
Because they are not in use.
Or not even in use. We are included within the future trading losses an early termination penalty of 6 million for assets which is deemed surplus to what? Surplus to requirements. Okay.
Requirements, yeah.
We are terminating this particular one. Okay. We are terminating this particular one because we are coming to what? We are coming to close down this particular what? Organization. Okay. The surplus to requirements over there doesn't mean that it is going to be worthless. Surplus to requirement means that since we are closing that particular one, we cannot use it anywhere again. So that makes it what? Surplus to requirements. Okay. Surplus to requirement doesn't mean that the asset is what is damaged and we cannot use it again. Okay. We are saying it is surplus to requirement because we actually hire or we actually lease this particular asset for the subsidiary. But since we are selling the subsidiary, we cannot use it anywhere again. That is why we are calling it surplus to requirement. If not for the sale of the what? The subsidiary, would there be any termination of the lease?
No,
Okay.
they wouldn't have been there.
So the cost that we are going to be making provision for will be what? So let's come to the restructuring provision over here, or provision. We make provision to the redundancy cost, isn't it? Of how much? Provision for redundancy cost is how much?
5 million.
Okay, it's a cost that we are incurring specifically from the sale. The termination, okay, lease termination penalty is how much?
6 million.
Okay, 6 million. Do we make provision for future operating losses?
No.
No, sir, we don't.
Okay, so you take the items, we only make provision for the redundancy cost and also the termination. Various legal costs of sale. What did we say about that? This will be
Yes,
treated
I
as
will
what?
make.
No, we don't make provision for this. This is a cost to sell. So this will be adjusted against the fair value that we are going to be getting from what? From the sale of the asset. This will be adjusted against the what? The fair value to have the net realizable value, which we are going to be comparing with the what? With the carrying value to classify the asset as held for sale. Okay. So the various legal costs of sale. These are costs relating to the sale. These are costs to sell. So this will be paid out of what? Out of what? The amount that we are receiving. So it will be taken away from the what? From the fair value to get a net realizable value. Okay, so this will be adjusted against the net realizable value to get the cost to sell. Impairment loss on own assets. Impairment loss on own assets. What will happen to the impairment loss on own assets? Do we make provision for impairment?
No.
Okay, impairment, since there is an impairment, the impairment will be treated in line with what? IAS 36.
Yeah.
So that will be treated in line with what? IAS 36. So we are only going to be making a provision of what? 11 million. That will be in relation to the costs that are incurred as a result of what? The sale or the restructuring or whatever we are doing over here. That will be the termination of the lease and also the redundancy cost of what? Of the employees. 5 million and 6 million. The 30 million provision cannot be made for, we don't make provision for future operating losses because they do not what? Present an obligation. Okay. The various costs of sale will be adjusted against what? against the fair value to have the net realizable value. So that will be taken into consideration when we are determining the net realizable value of the subsidiary to be classified as held for sale. Operating losses on own assets will be recognized in profit or loss when they are being what? When they arise. That will be treated in line with what? IAS 36. Okay. So the entity, the accountant should classify the subsidiary as held for sale or discontinued operation because the decision has been made to sell it, and this has been reported in the media. It means that the entity has now taken an initiative to get a buyer for the asset. They have even identified a buyer. They have even identified the buyer. You can see that a buyer has been identified. The Old Castle, an entity which currently owns the 20%, will purchase will acquire the 80%. So it means that buyer has been identified. So the subsidiary made a recognition criteria to be classified as held for sale or discontinued operation. Okay, and this should be classified at the lower of cost or its net realizable value. Okay, then if you come here, the sale is going to be creating a cost that will be incurred as a result of what? This particular one. There will be costs that will be arising from the sale, and that particular cost has to be what? How to be provided for. Okay. Since they are committed to the sale, it means that the sale will be made and some of the employees will be made redundant. So the entity should make a provision for a redundancy cost of what? 5 million. If the sale is being made, they are going to be terminating a lease that is currently on asset. They are going to be paying 6 million. We are incurring these costs as a result of the sale. So these two costs should be provided for. So we should be taking to profit or loss 11 million, but the legal cost of sale will be treated as cost to sell. Okay, the impairment loss on own assets will be treated as impairment loss in the profit or loss when it has actually, when it is being incurred or when it's occurred for that particular year. That is how we are going to be doing with this one. So you just talk about, this particular question is about 37 and the same time, 5, IFRS 5. So we just talk about it and list the amount that they are going to be making provision for and the entries that they are going to be passing for that particular one. Okay, what are we going to be? Any issue before we move on to dismantling cost as the last one? Okay, or let's pick within 3 minutes, let's pick additional question on the restructuring. Then we see what we can do the restructure. Okay, restructuring. Okay, can we take, okay, this one is a very simple one. Can we take the question number 1? Okay. You just list the course that they are going to be doing there.
Okay, so question number 1.
Sure.
WH has announced the closure of one of its division prior to the reporting date and is unsure which costs to include in its provision. The closure is expected to take place on 1st March 20X5 and WH's reporting date is 30th November 20X4. The accountant is planning to recognize the following cost within provision: redundancy costs, operating losses expected for period from 1st December 20x4 to 1st March 20x5, legal and professional fees relating to closure, and then staff retraining required. Advise which of the costs should be recognized within a provision for closure of the division as at 30th November 20x4.
Okay, so what will be the costs that will be recognized? What are the costs that we are going to be recognizing?
Legal and professional fees related to
Okay, you will not just stand up and say those ones. Oh. What if they are giving 5 marks for that? What if they are giving 5 marks for that? What are you going? How will you start it? How will you answer it?
So you start to talk about the recognition criteria for making provisions for restructuring costs.
Which includes what?
Which includes the detailed plan, having a detailed plan about it, the plan being communicated, and then measures being taken to ensure that it's actually going to be effective.
Okay, so is that the case for these people?
Yes, sir. You see, they have a specific date that this closure is going to happen, and that's on the 1st March 20x5.
Even they announce it, I guess
Yes.
it has been announced. So it means that the I-37 states that provision should be made for restructuring if and only if there is a detailed plan to the restructuring. The plan of valid consideration has been made as a result of announcing it or communicating the plan to those who are affected, or they have started implementing the plan. Okay, in this case, HH has they have a detailed plan, and the plan has been announced to those who are going to be those who are going to be affected, and the date is also being set for that particular one. So it means that they are highly committed, or the possibility of the restructuring happening is very high. Okay, the standard states that only costs that are necessarily incurred by the restructuring and are not associated with the ongoing activities of the organization should be recognized as a provision, isn't it? Okay.
Yes, sir.
Therefore, okay, let's mention the cost now. What will be the costs that are going to be recognized here?
You have the redundancy costs.
Okay.
No fees relating to the closure.
Okay, you can see that legal and professional fees are relating to the closure. There are specific costs for the closure, isn't it?
Yes, sir.
Okay, so these are the costs that are necessarily incurred by by the restructuring. Okay, but the operating losses, what will happen?
Oh, there will be no provisions made for the operating losses.
Okay, you have to explain why. Okay, why?
You know that
Operating losses will be treated in a P&L.
Because there are expectations down.
Because it does not
creating legal obligations.
Okay, you cannot, if you mention the cost, why it will not be recognized, you have to state it. Okay, what about the staff retraining?
staff retraining is a cost that will be incurred whether restructuring is done or not.
Okay, it's a cost associated with what?
Ongoing activity.
Okay, it's a cost that is associated with the ongoing activities of the organization. Okay, that is a very simple one. So that is basically about what? About the restructuring. So if they are giving you a question, it should be able to what? You only make a provision when the restructuring is what? Is possible. So you're giving information that okay, this thing has not been communicated to the employees and those kind of things. But if the entity started implementing the restructuring, it means that they have started implementing, they have an obligation to pay the redundancy cost and any other cost that will be coming with that one. Let's come to the issue of dismantling or decommissioning costs. Okay, corporate reporting people, this place is very important for you because they are now setting questions on what? On reassessment of the what? Of dismantling costs. what we know is that the dismantling cost is going to be 10 million for the 10 years. There can be a situation where what we are basing the 10 million on has changed, and the provision will also change now, or the discount factor can change. How do we account for that? That is an area for corporate reporting, although financial reporting, you can also see that because these are all part of the 37. Okay, so let's come to decommission costs and dismantling costs. Okay, we are all familiar with this because we have done IS 16 and we have looked at the initial cost that will be included in the assets. Okay, mostly if you count to these concession arrangements, especially the mining and those ones, okay, if the license is being granted to what? To the company, the mining company, they will be given a concession for a particular period, like they should do the mining for 10 years. After that one, they are always asked to what, or they are always required to what? To bring the land back to what? To each original stage, or whatever property or whatever asset has been mounted on the land, they are always allowed to what? Allowed to remove them from what? From the land. They should bring the land to what? To the original state. Okay. The question is, if it is the plant that we are going to be removing, okay, if the plant has not been mounted there, there is no way we are going to be incurring those costs. If the plant has not been mounted there, there is no way we are going to be what? We are going to be carrying out those particular issues. What will happen is that, let me write the dismantling. Okay, let me write the dismantling or decommissioning. Okay, decommissioning. Okay, the issue is, if not for the asset that has been mounted there, no issue of this commissioning will be done. Okay, what normally happen is this one. What normally happen is this one. Mostly what will happen is that the entity will always give you a future value of the cost. Okay, what do we call the future value of the cost? They will give you the amount that they are going to be what? They are going to be incurring on the time that what? The restructuring will be done. Okay, the dismantling will be done. So if they are going to do this in 10 years time, they are going to be what? They are going to be giving you the amount that will be incurred in 10 years time. Okay, we are removing the plant that has been mounted on that particular place. Okay, as soon as we started operation, what does it mean? It means that we have the obligation to remove the what? We have a present obligation that will be making us to remove what? The plant from the surface of the land, isn't it? As soon as we started operation on that particular land, we have
Yes,
a present obligation of what? Removing this particular one. Okay,
Yes, sir.
so what we do is that since the contract has been signed and we have mounted what? Plants on that particular property, that particular land, and we have started operating, as soon as we have started operating, it means that you have the obligation to remove the plant from that particular one. You have an obligation now, a present obligation to remove this particular one in the future. Okay, so what will happen is that since we have a present obligation now, we need to recognize what? A liability for this particular present obligation. So the question is, assuming we want to remove the plant now, what will be the amount that we are going to be what? We are going to be incurring. So you make a provision, which will be a liability. Okay, you make the provision to the present value of this one, which will be 1 over 1 plus R exponent n multiplied by the future value. The question will give you the future value. Then you have your amount over here. Okay, you have the amount over here. Why are you incurring this particular one? Why are you incurring this particular cost? You are incurring this particular cost because of the plan that has been mounted there, isn't it?
Yes.
Okay, so what will happen is that we say that this provision or the dismantling cost is part of the cost of the asset. So we debit the assets. This one, it will not go to profit or loss. The debit entry will go to the asset. So we add that particular value to the present value of the asset because it's a cost that we are incurring directly on the asset. We are going to be incurring this cost to remove the asset. So if not for the asset, this cost will not be incurred. Okay, this cost will not be incurred. Sometimes they will not give you the asset, but they will just give you a license. So you are doing the decommissioning because of the license. So if they give you the licensing fee, if they give you the fee for the license, you add a present value to that one. So the initial recognition for this particular one, what we normally do is that we recognize the provision to represent the present value that we have, the present obligation that we have over here. As far as you have signed a contract and you have mounted a plant, you have started operating, as soon as you started operating, it has now given you an obligation. You now have the obligation to what? To remove that particular plant. You have a present obligation to remove this particular plant at the future date. Okay, so what we do is that we find a present, we made a provision to the present value of this. The assumption is that the value given to the future, there is a financing component, there's a time value component of it. Assuming we are paying today, how much are we going to be paying? We do what? We do we present value or we discount the cash flow. If you come to the subsequent measurement, what do we do? The subsequent measurement is the asset. Okay, the asset will be depreciated now. So the asset will be depreciated together with the dismantling cost. But the provision, since the amount supposed to be a future amount, we are present value it now. Every day we'll be compounding it. So it's just like you have put 5,000 into account today and you are getting interest of 5%. So what will be the amount at the end of the year? You calculate what? 5% interest on this one, recognize it as what? As income, if you are going to be what? If you are going to be receiving if this is an asset for you. But if this is a liability for you, it means that someone has given you 5,000 now, and the person will be charging you interest at 5% for every year. So the interest will be 5% on this one, which will be 250. At the end of the year, you are owing the person 5,000 plus 250. The beginning of the second year, you are owing the person 250. So since this is assumed to be compound interest, so the interest together with the principal amount will be any interest. So the second year, your finance cost, the interest that you are going to be paying to the person will be 0.05 multiplied by 5250. Then you get a figure. At the end of the first, you add the interest again. That is how we do the provision. So we try to increase the provision by the discount factor or the cost of capital that we use to have the total value in the future. So the provision will be unwinded. Okay. Someone will say unwinding the provision. Unwinding the provision just means that we are compounding the provision. So we normally calculate the finance cost on it. How would the finance cost be calculated? It's just the cost of capital, let's say 10% or 5% multiplied by the provision at the beginning of every year. Okay. The provision value at the beginning of every year, or at the end of every year, or at the beginning of every year. So provision value at the start of every year. Okay, so that's how we do. So the finance cost will be taken to profit or loss. So the depreciation, we know how to account for depreciation, but the finance cost, what we do is that we debit profit or loss with the finance cost. Let's say this one. Then what will happen is that the finance cost, we are not paying. So it will be increasing our liability. That will be added to the liability now. This is how we go about it. This particular one, the situation is that the entity is not going to be selling what? The entity is not going to be selling the right to any other party. Okay. So if it is 10 years, they are going to operate for 10 years. So they have the obligation for 10 years. I'm not sure they can give you a question where they will say the entity will run the place for what? Run the place for 6 years and they will sell it. Okay. So if they will run the place for 6 years and they will sell it, okay, they can actually make the provision for 10 years because after this date, there is no issue of what? Selling it. But if they saying that they are going to run it for 6 years and sell it for 4 years, then they will make provision for 6 years because the remaining 4 years provision will be given to what? Will be given to another person. Or they can make the provision for the 10 years if it has been sold, then they will recognize the liability. There's no problem with that. But this one, the assumption is that they are going to operate for the what? For the full year, there will not be any sale or anything. The entity is going to be operating for the full year. There will not be any sale and there will not be any situation of that. Okay, let's pick 2 questions on this one. Then we see how we can actually go about that particular situation here. Charles, are you there?
Yes, please, I'm here.
Question number 8.
Okay, so question number 8. On 1st January 2020, ABC PLC acquired a new mining license to extract gold through surface mining technology at a cost of 360 million Ghana cedis in Ahafo district. One of the terms of the granting of the license is that ABC PLC will have to restore the land topography to an environmentally satisfactory condition in 3 years' time, when the gold deposits would have been exhausted. The estimated cost of this on 31st December 2022 will be 100 million Ghana cedis. The cost of capital applicable is 25% per annum required. In accordance with IAS 37, provisions, contingent liabilities, and contingent assets demonstrate how ABC PLC should account for the above information in its financial statements for the year ended 31st December 2020.
Okay. So they are saying this in accordance with 37, what this should be done. Okay, what you can do is that you know how this will be done. So you can just say that the ABC Limited should make a provision up to the what? Up to the amount of the present value of the amount that will be paid to what? That will be paid to restore the land, which will be added to the value of the asset. You can just write English over there before you start your workings. Okay. You can just write certain English there to demonstrate or to explain shortly how this will be accounted for. Okay. So the entity should initially what? Recognize a provision, which will be the present value of the 100 million that will be settled in 3 years' time, which will be added to what? To the cost of what? The license. Okay, let's come here. So let's come to question. Charles, question number what is what? Question number.
So it's question number 8.
Okay, question number 8. Okay, question number 8. That is ABC Limited, isn't it? Okay.
ABC PLC.
Okay. ABC PLC. Okay, ABC PLC. She recognized a provision at the present value of the future value of 100 million. Okay, of the future value of 100 million discounted at what? 25%, isn't it?
Yes, sir, 25%.
Okay. And added the same amount to what? To the value of the asset, isn't it?
Yes, sir.
So you just come here and have your initial recognition. Okay, initial recognition. So initial recognition. Okay, what is the asset in this question?
The asset is 360 million.
Okay, but the asset is now is a new license, isn't it?
Yes, sir.
Okay, so it is a license that is giving us that particular obligation to. So you just add the present value to the license. Okay, so let's come to the cost of the license. Okay, the cost of the license. We have the acquisition cost, isn't it?
Yes, sir.
Acquisition cost of 360, isn't it?
Yes, sir.
Okay. So the dismantling cost will be what?
It's a present value of that 100 million.
So that will give us 1 over 1.25 exponent 3. Is that correct?
Exponent 3, yes, sir.
Okay, that will last for only 3 years. What are we having?
So 51.2.
51.2. Okay. The total will give us now how much?
Total gives us 411.2.
411.2. Corresponding entry will be provision, isn't it?
Right, sir.
Provision of what? 51.2.
51.2.
Okay. Let's come to at the end of at the end of the year, which will be December. At the end of the year, December 2020, what will happen? The license will be amortized, isn't it?
Yes, sir.
Amortization will be 411.2 divided by what?
3 years.
Okay, what are we having? That will be a full year amortization.
137.1.
Okay, 137.1. Okay, then we come to the finance cost for the finance cost will be what? 0.25 multiplied by 51.2. Are we correct?
Yes, sir.
What are we having?
12.8.
12.8. Okay. So if we come to statement of profit or loss here, what will be the items that will come here? Depreciation
Depreciation.
of how much?
137.1.
Okay, 137.1. Finance cost of what?
The finance cost of 0.8.
Okay, 12.8. Okay. Then we come to statement of financial position. Statement of financial position. What are we going to be having? We have
License.
okay, we have non-current asset first, isn't it?
Yes, sir.
Which will be the license of how much? 411.2 minus 137.1, isn't it?
Yes, sir.
Non-current liability will now be the provision. The provision will be what? 51.2 plus what?
12.8.
Okay, what is the total for each of them?
So the assets gives us 274.1,
274.1.
and then the liability is 64.
64.
Yes, sir.
Okay. So if you are doing for 2021, okay, let me show you the finance cost. So if you are doing for 2021, the finance cost will be calculated like this. Okay, the finance cost will be 0.25 multiplied by what?
By 64.
Okay, thank you. So the finance cost will be calculated on the provision at the beginning of every year. 64 will be the figure at the beginning of every year. We are just compounding it. So the interest together with the principal will be rollover, and the interest will be charged on the two. It's just done like compounding. Okay, it is a future value that we have present value. So it means that we have to compound it to get what? To get our future value again. So this is about the provision. Okay, don't worry. I'll be taking maybe 10 minutes of your time, but it's all good. We are going to, let's pick another one question. Then we go to the reassessment area there. Question number 11.
Okay, so question number 11.
Yeah.
Promoil's financial statements for the year ended 30th September 20x8 were authorized for issue by its directors on 6th November 20x8, and the annual general meeting will be held on 6th December 20x8. On 1st October 20x7, Promoil acquired an oil platform at a cost of 30 million Ghana cedis. The estimated cost of removing the platform at the end of the asset's life on 30th September 20Y7 will be 15 million Ghana cedis. The present value of 1 cedi in 10 years using Promo's cost of capital is 8%, or capital of 8% is 46 pesos or 0.46 Ghana cedis. Required in accordance with IAS 37 provisions, contingent liabilities and contingent assets, demonstrate how Promoil should account for the above information in its financial statements for the year ended 30th September 2018.
Okay. Okay. So this one, our focus will be on the provision, isn't it?
Yes.
Okay. What is the cost of the assets?
30 million.
30
Okay.
million.
But we are incurring a cost of 15 million to remove it at the end of 30th September 2Y7. How many
Yes,
years
sir.
from now?
That's 10 years from now.
Okay, that is 10 years. Okay, question number 11. Okay. My corporate reporting people, okay, they can actually give you a question on this one, but your one will be more complicated than this one. So that is why we are going to be looking at the reassessments of the dismantling cost. Okay, let's come here. So let's come to initial recognition, which will be 1st October. Okay, the 1st October, we have the cost of the assets. Cost of the assets will be the oil platform, isn't it? Okay. The oil platform. The cost itself is what?
30 million.
Okay, 30 million. So we add the dismantling cost, isn't it?
Yes, sir.
The dismantling cost, they have given you the discount factor already. The discount factor is a 0.46 given to you. If you like, you can check that one and see. So you can have
Okay.
1 over 1.08 exponent 10. Okay.
Correct, sir.
Okay. So that one C that they are talking about over there is the discount factor given to you. So we have 0.46 multiplied by 15 million. Is that correct?
Yes, sir.
6.9.
So we
That's
have
right.
6.9. So we now be having 36.9 million. Is that correct?
Yes, sir.
So we make a provision of what? 36.9 million.
6.9.
Okay. Subsequent measurement, which will be the end of the year, what will happen?
6.9 or 36?
Sir, the provision is 6.9.
6.9. So subsequent measurement will be what?
Subsequently,
Depreciation or amortization of the oil platform. Okay.
Yes, sir.
The oil platform, is it going to be depreciation, amortization, or what?
Depreciation.
Okay. I hope you have seen this word before.
Depletion.
Yeah, this is a wasting asset. Okay. So as they consume it, then the benefits will be what? As time goes on, the benefits will be out of it. So those oil platform, those minerals, we call them a wasting asset because their benefits they will become useless after the benefit has been consumed. So we use depletion for them. Okay. But if you use depreciation, nobody's going to see anything because this is an oil platform, this is a mineral. Okay. But whatever you are going to be using will be the same answer that you are getting. So we have 36.9 divided by what? 10. Is that correct?
Yes, sir.
What are we having?
Zero point
0.6.
3.69. Okay. Before we move on, let me say this. Okay. The entity, they consider the asset has been purchased. They consider the asset, although we solve the question that we solve we solve a question on a particular one where we solve a question under foreign exchange rate where we have the issue of provision and those ones. I've said it, but let me say it over here again. The asset can be acquired on January 1, okay, 2021, but they will say that it is available, it has been made available, not put to use. They will say that it is available to use on 2021. And they will give you that the entity has a dismantling cost of removing of 20 million. Please, you start making a provision from the time that you start making a provision from the time that the asset has been made available for use, or the asset can be purchased on this particular date, and the asset will be made available, or they can say the entity has done an extension, they have carried out some major work on the asset, and that major work will be capitalized because it's part of the cost to make the asset ready for use. Okay, and they will say that the asset was made available the next year which is 2022. Okay, if you are giving this provision in 2021, the asset was not put to use or the asset was not ready for use. So no provision will be made for what? For the entire year. Provision will also start from the time that the asset is available for use. So you also start a provision from 2021. You start recognizing a provision from this particular date. Okay, I've said that, but maybe when we are doing the 21, but you might what? You might what? You might not remember again. So it just something that I'm saying again. So we have a finance cost of what? Of 0.08 multiplied by 6.9. Is that correct?
Yeah.
Okay. What are we having?
$0.55.
0.55. Okay. Statement of profit or loss. We have the depletion of 3.69 million. Finance cost of what?
0.55.
0.55. And in the statement of financial position, we add a 0.55 to 6.9 and we subtract the what? The depletion amount from what? From the value of the asset.
Yes.
Let me come to the reassessment of the dismantling cost. The reassessment is just the what? The change in the dismantling cost. Okay, reassessment of dismantling cost. Okay, how do we go about it? It's a very simple area, but you have to be very careful with it. Reassessment of dismantling cost. Okay, let's come to this question. We can see that we are saying that we are going to be incurring 15 million at the end of the 10th year, isn't it? At an interest rate of what? 8%. Okay, we can be done with 2 years. We can be done with 2 years, then they will tell you that the interest rate has now increased to 10, the interest rate has now been revised to 10%, and the amount has also been now revised to 12 million in total. Okay, this is what we call the reassessment, a change in the provision. So it means that the liability that you are recognizing will no longer be the liability again. Is that the case? Okay.
Yes,
So
sir.
what you do is that you have to determine the new liability now. So let me use that one as an example before we pick a question. Okay. So let's assume that this was given to us 2x7, isn't it?
Okay.
2x7. We have the dismantling cost to be what? 15 million for what? For 10 years, isn't it?
Yes,
The
sir.
cost of capital,
8%.
the cost of capital was 8%. Okay, let's bring this one here. Okay, we are going to be paying attention to this one. Okay, but before that, let me come here. How do you account for the reassessment? Okay, how do you account for the reassessment? The accounting treatment depends on the measurement basis that the entity is using. Okay, we know that assets can be carried under 2 measurement bases, isn't it?
Yes, sir.
We have cost model and what?
The revaluation model.
And the revaluation model. Okay. Okay. If the asset is carried under cost model, okay. If the asset is carried under cost model, it's very simple. If the asset is carried under cost model, okay, any increase or decrease, as a result of the reassessment, will be treated, any increase or decrease as a result of the reassessment will be adjusted against the asset, against the value of the asset, or the carrying value of the asset, against the carrying value of the asset, and the carrying value against the carrying value of the asset, against the carrying value of the asset, and the carrying value of the liability. I will explain that, which is a provision. Okay. If you are carrying the asset at cost model, it means that the asset is cost less what accumulated depreciation, isn't it?
Yes, sir.
Okay. So if the provision, you consider the provision that we have over here, this will be 6.9 plus 0.55, isn't it?
Yes, sir.
Okay, what will be the total?
7.45.
7.45.
45.
Okay, 7.45. Okay. The asset will be, at the end of the year, the provision should have been 7.45, isn't it?
Yes, sir.
Okay. Assuming we have done the reassessment and the value of the provision has now been, let's say, 7.85. It means that the provision was what? Undervalued, isn't it?
Yes, sir.
So what we do is that we increase it by 0.4. Is that correct?
Yes, sir. 0.4.
Okay. Since this is carried under cost model, it means that we have also the amount that we have added to the what? We have added to the provision, we have added to the asset was also undervalued, isn't it?
Yes, sir.
So the amount that you are adding to the provision, the same amount will be added to the asset. Please, this is treated as a change in an estimate. So it will be having a prospective effect. Don't go back. Don't be saying that, okay, the interest rate that should have been charged in the first year is 10%. So let me go and adjust. No, this is a change in an estimate. So all the
Yes, sir.
effect will be having a prospective what effect. So you adjust from the time that the change has been made. This is a change in an estimate. So if it is carried under cost model, any increase or decrease in the what in the provision as a result of the reassessment will be adjusted against the carrying value of the provision in the books of the entity and the carrying value of the entity in the books of the what the carrying value of the asset in the books of the entity at the date of the change. Let's come here. What if this is carried under revaluation model? Okay, if it is carried under revaluation model, okay, the assumption is that whenever the asset is being revalued, it is being revalued together with the provision. Okay, when the asset has been revalued, you consider the value of the asset over here is what? Is 30 plus 6.5, isn't it? Okay. If the asset has been revalued, it means that the cost of the provision included in the asset has also been revalued. So it means that we are carrying the provision also at a revalued amount. Okay. So any difference in the what? Any difference or any increase or decrease, as a result of the reassessment is adjusted between the revaluation reserve or the revaluation amount and the liability. Okay, and the provision rather. Okay, what it means is that we are carrying the provision also as what? As a revalued amount, because when the asset is being revalued, the present value of the provision that has been added to the asset will also be revalued as well. So if we are now reassessing the liability, it also means that we are revaluing the liability. So if the liability is now increasing, that is a loss to us. So it means that there was a revaluation on the what? On the liability that is recognized in the revaluation reserve. So now it's a loss on the liability. The revaluation that was recognized first must be reversed. We treat it like how we treat a normal revaluation, surplus and what? And loss. Okay, so if it is carried under revaluation model, whenever the asset is being revalued, it will be revalued together with what? Together with the provision. So it means that we have recognized a revaluation relating to the provision in the revaluation reserve. If there's a loss on the provision now or the liability is increasing as a result of the assessment, we have to now go and reduce the revaluation that the reserve that has been recognized relating to the liability. If there's any gain over there, we still take it towards the revaluation reserve. Okay. But if the question is telling you that the asset has been revalued, the asset has been revalued without the what? Without the provision amount. It means that the provision is under cost model. So we count to the first one. The question can tell you that the asset has been revalued to a particular amount without the provision. So it means that the provision is not having any revaluation. So any increase or decrease will come back to what? This default method. But it is under real or limited situations that will be giving you those issues. Let's pick one question, a question that I haven't solved before. There is one that I have been solving. So let's pick the one that we haven't done before so that since some of you watch the old one, there is no problem with this one. Question number 15, Charles.
So question number 15.
Yeah.
Odishiaba PLC owns a large manufacturing plant. In view of significant changes in technology, the entity has decided to reduce the remaining useful life of the plant by 5 years. For the current year ended 30th April 2023, no entry has been made for depreciation on the plant, neither has there been any adjustments to decommissioning cost. As at 1st May 2022, the plant had a carrying value of 6 million Ghana cedis and a remaining useful life of 11 years. Further, in respect of this plant, revaluation surplus of 960,000 Ghana cedis and provision for decommissioning cost of 1,600,000 Ghana cedis were also appearing in the books as at the date. There is no change in expected decommissioning cost except for the timing due to change in useful life. Applicable discount rate is 11% per annum. It is a policy of Odishiaba to transfer revaluation surplus to retain earnings only upon disposal. Required, advice on the appropriate financial reporting treatment for the above in the books of Odishiaba PLC in the 2023 financial statement for the year ended 30th April 2023.
Thank you very much. Okay, thank you very much. So this is how they are going now. This is how they are going now. So this is how they are going now. For corporate reporting, they will examine you on the technical issues and the reassessment of dismantling costs is a new area that you have to look at for. Okay, let's come here. Okay, let's come here. They are saying that the entity owns what a large manufacturing plant. In a view of a significant changes in technology, the entity has decided to reduce the remaining useful life of the plant by 5 years. For the current year ended, no entry has been made for depreciation on the plant, neither has there been any adjustment to this commission cost. So it means that no entry has been made yet. No depreciation has been charged on the what? On the asset. That's what they are saying, isn't it? Nothing has been done on
Yes,
the
sir.
asset. No entry has been made on the asset. So the depreciation has not been made on the original one. Okay. As at 1st May 2022, the plant had a carrying value of what? 6 million and a remaining useful life of what? 11 years. Further, in respect of this plan, revaluation reserves of 960,000 and provision for this decommission cost of what? Of 1.6 million were also appearing in the books as at that date. There's no change in the expected decommission cost. So this is not the what? This is not the original decommission cost. It was we have an original decommission cost that has been unwinded and we are having a present value now at this amount, isn't it? Okay.
Yes, sir.
They are saying that there is no change in the original one. So if it was 100,000 first, there is no change. So we are still, a certain amount of money was expected to be incurred at a particular date, and we have present value it. We have compounded it, and we now have 1.6 million in our books. Okay, there is no change in the expected decommission cost. Sometimes they can give you the expected change. They can give you a new decommission cost, and they can also give you a new discount rate. But this one, what is changing? It's only the useful life that is changing, isn't it?
Yes, sir. Only the life.
So if the decommission was for 10 years, now we are doing it for 5 years. What it means is that we are going to be using the same amount. If it is 100 million, we are going to be using the same 100 million. Okay, so I will show you how you can go about that one. It's a very simple exercise. There is no change in expected decommission cost except for the timing due to change in useful life. Applicable discount rate is 11%. It is the policy of the Odishiaba to transfer revaluation surplus to retain earnings only upon disposal. Okay, so advise how they should account for this. This transaction should be accounted for as a reassessment or a change in a provision, which will be treated as what? As any increase or decrease being adjusted against the provision amount and the revaluation reserve, because they are using revaluation model for this particular one. So let's come to question number 15. a very simple one. So we have question number 15. Okay, we have the, or the, okay, whatever be the case, we can not waste time on that. Okay, so when are we doing this? We are doing this on May what? 1, 2x2, isn't it? Okay, the carrying value of the asset as at this date is what?
6 million.
Okay, that was 6 million. Okay, the revaluation surplus on the account is what?
I think 960 also. 960,000.
Okay, 960,000, isn't it?
Yes, sir.
Okay, okay, 960,000. So we come to the provision also at this date.
1,600,000.
Okay, 1.6 million, isn't it?
Yes, sir.
Okay. What is happening is that there will be a change in the provision. Okay. Let's come to the depreciation. At this, the depreciation will be very simple. At April 2023, the depreciation will now be what? The same amount. The depreciation, the change in useful life is also a change in an estimate, isn't it?
Yes, sir.
So we look at the carrying value of the assets as at that day divided by the remaining what? The 600 will now be used for how many years? 5 years. Okay, they have now reduced. Okay, let's go there again. They have now reduced. Okay, the entity has decided to reduce the remaining useful life of the plant by 5 years. So that will be 6 years. Sorry. Okay,
Yes, sir.
that will be 6 years. Okay, so they have decided to reduce it by 5 years. So it means that the remaining useful life was 11 years, but they are reducing it by 5 years. So that will be so this is a change in an estimate. So the carrying value over the remaining useful life, that's how we go about it. We don't do anything like, okay, so if the asset should have been the 6 years from the beginning, what will happen? No. If there's a change in an estimate, we look at the carrying value at the date of the change, then we spread it over the remaining what useful life now. How much are we having at the end of every year?
1 million each year.
Okay, that will be 1 million. Okay, let's come to the provision. The question is not about the asset, it's about the provision. Okay, they are saying that we have a provision. The current value in the provision now is what?
1.6 million.
Okay, the provision is now having a present value of 1.6 million, isn't it?
Yes, sir.
Okay, they are saying that it is left with additional what 11 years to what to complete the provision, to carry out the provision, isn't it?
Yes, sir.
So the question now is, it was a certain amount of the provision. Let me use this question here. Let me use this one. Okay. Let's come here. All right, let's come here. What is the amount over here? Okay. What would be, okay, the provision over here at the end of this year is 7.45, isn't it?
Yes, sir.
Okay. And this will be left with what?
9 years.
Okay. And we at an interest rate of 8%, isn't it?
Yes, sir.
Okay. If we want to know the value of the provision in 10 years' time, how do we calculate it now? We have 9 years left now, but it's 10 years. So if you want to know the value of the total provision, what do? It means that we'll be increasing the amount by 8% at the end of every year, isn't it?
Yes, sir.
Okay. This means that we can actually use a future value to calculate this. Okay. So I can use a future value of, because I know that the amount will be increasing, so I can have 7.45 now into bracket 1 plus what? 0.08 exponent 9. Do you agree?
Yes, sir.
Okay. So we'll be having 7.45, 1.08 exponent 9. What are you having? You should be having something equivalent to 15 million.
14.89.
Okay. But the amount was 15 million first, isn't it?
Yes, sir. 15 million.
Because of the approximation. So we can actually make it 15 million. Is that correct?
Yes, sir.
Okay. So let's come to this question. The present value of the provision now is what?
1.6 million.
We have a remaining useful life of what?
11 years.
Okay. At a discount rate of 11%, isn't it?
Yes, sir.
Can we find the the actual provision? Can we know the actual provision cost that we are going to be incurring?
For the remaining years.
For the actual provision cost that we are,
That has been.
okay, the actual provision cost that we have present value, the amount that we are going to be getting, the actual provision cost is the one that we are going to be getting at the end of the useful life of the asset, isn't it?
Yes, sir.
Okay, they are saying that the present value of it is what? Is 1.6 million. It has what? A remaining useful life of 11 years, and it has 11%. It means that this provision will increase by 11% every year for how many years? 11 years, isn't it?
Yes, sir.
Okay. So we can also use the same formula, the same principle that we use for this particular one to find the original, okay, to find the original cost of dismantling. Okay, that will give us the present value into bracket. You can just use the word, the compounding or the future value formula. You are giving 1.6 million at 11%, and they are saying that this will be what? This will be withdrawn. We are going to be carrying out the provision in 11 years' time. So what would be, if you are investing a certain amount of money now at 11% for 11 years, what will be the future value? Very simple. So we can calculate the future value, which represent the what? The total amount that we are going to be incurring on the provision. So let's go there. What are we having? 1.6 million. Okay. 1.11 exponent what? 11. What are we having?
5 million.
Okay, 5 million.
42,811. 504.
0.67.
So 504.
2811.
2811.67.
Or let's
Yes,
just make 2812.
Okay.
Okay, 0.67 is at the top. So let's just make it to the nearest what? The nearest figure. Okay. So 504. 504.
2811 or 2812.
2811.
122.
Okay. So this is actually the what? This is actually the total provision cost that we are going to be incurring. This is the total cost. Okay, this is the total cost. Okay, this is the total cost. So this is the total amount that we are going to be what? We are going to be incurring. This is the total amount that we are going to be what? We are going to be incurring. Okay. This is the total amount that we are going to be incurring now. Okay, let's come here. This is the total amount that we are going to be incurring. But the useful life of the asset is now reduced to what?
6.
Okay.
To 6 years.
So it means that we have 6 years. We have 6 years remaining to spend this particular amount, isn't it?
Right, sir.
Okay. So now, don't go back and do anything because you are not giving the total useful life of the asset. Okay. So now, we have 6 years to be able to spend this amount of money now. Okay. If we are going to be spending this amount from 6 years now, what will be the present value of this amount? We are spending this amount will be spent 6 years from now. So what will be the today's value? So present value will give us
that amount multiplied by our discounting factor.
Okay, 1.11 exponent 6, isn't it?
Yes, sir.
Multiplied by 5042812. What are you having?
Moment, sir. So that's 2696093.
269
6093.
6093, isn't it?
Yes, sir.
So it
someone
means someone should confirm that. Let's move on.
That's correct.
Okay. So what it means is that based on the new useful life now, the present value of our provision should have been what? The value of provision as of today should have been what? 2,600,000 and what? 96,093. Is that correct?
Yes, sir.
Okay. But what is the present value of the provision in the books of the entity?
1.6 million.
What is the difference?
1096093.
Okay.
Yeah, that's correct.
So let's come to the adjustment to the provision. That will be 269,26960. Okay. 2696093 minus the current value that we have now. Okay. That current value is based on 11 years, isn't it? Okay.
Yes, sir.
But we know that the total amount that we have over here now, the total amount that we have, this is the total amount that we have to spend. Okay. But we are spending what? We have 6 years remaining to spend this amount. Okay. So what would be the present value for this particular amount as of today? The present value that we are getting over here, it includes the present value from the beginning based on new estimate plus all the interest. So this amount that you are getting over here includes all the present value from the beginning plus the interest that should have been done up to the time that the changes have been made. So what you do is that how many years are left on the contract? Just calculate the present value from that one because the amount that you have now, you are going to be spending it 6 years from now. So assuming I want to spend this amount now, what is the present value? And that is why we have the 26 over here. What is the difference?
So 1096093.
109.
6093.
Okay. What will be the treatment over here? We increase our provision by that amount, and the corresponding one will be what? If the liability is increasing, is it a gain or loss?
A loss. So we debit our P&L.
We debit, no. This is carried under revaluation model.
Okay.
So we debit OCI because we have a revaluation that can cover this total amount, isn't it?
Okay, sir.
So we have a revaluation that is 960 million. The revaluation is 960 million, isn't it?
Yes, sir. So it can't cover everything.
Oh, this cannot cover all. Okay.
Yes, sir.
So let's share that one. So how much will go to the revaluation?
136,093.
Now, the revaluation, we are going to be taking all the 960. Okay.
Yeah.
All the 960 will go. Then the remaining will go to profit or loss. That will give us what?
Okay, so the remaining is the 136,093. Sorry.
136.
093.
093. Then the corresponding will be credit what?
The provision.
Provision of the total amount. 1096
903.
093. Okay. So you can show their statement of profit or loss. Depreciation will now be based. The depreciation, the change in useful life is a change in an estimate, isn't it? That should be
Yes, sir.
that should be accounted for prospectively. So you just look for the carrying amount at the time of the change divided by the remaining useful life. So we have 1 million here. Okay. Then we come to there will be a finance cost, isn't it?
Yes, sir.
Because we are doing this at the beginning of the year. So there will be a finance cost at the end of the year. That will be 0.11 multiplied by the new amount now. Okay. Because we are doing this at the beginning of the year. So we have 269
6093.
6093. What are we having?
296,570.23.
296
570.23.
570. Okay, let's just make 570. Okay.
Okay.
There will
So you've
be
made it 07.
570.
no, mention the figure again.
296
570.
570. 296 570. Okay.
Yeah, the position of the figures.
Okay. So 570. Then we come to what? Revaluation loss, isn't it?
Yes, sir.
Okay, the revaluation loss will be 136,093. Okay. The other comprehensive income. There will be a revaluation loss of what?
960,000.
960,000. Okay. Statement of financial position. Okay. We have non-current assets and we have the plants. That will be 5 million, isn't it?
Yes, sir, 5 million.
Okay.
6 million of the depreciation.
Non-current liability will be provision of what?
10960.
No. It will be 260 plus the interest.
Yes, sir.
269 2696 269 93 plus what? 2965. Okay, what are you having?
That gives us 2992663.
Okay, Charlie, you can complete that one. Let me talk about contingent assets. Okay, I will just talk about contingent liability. That is the important one. Okay, and a contingent asset. Okay, sometimes there can be an obligation, but the possibility of settling that particular obligation depends on what? Depends on the future, or this depends on the occurrence of an event that is not under the control of the entity. Okay, so if you talk about contingent liability, okay, it's a potential liability, but it being a liability depends on what? On the occurrence of a particular event that is what? That is outside or that is not within the control of the entity. The example will always be a court case. Okay. The example will always be a court case. Okay. So when there is a court case, okay, the entity has sold goods to a customer and the people have used the goods and they are now filing for what? For, let's say, damages. The goods has now caused what? Damages to them. They are now calling for that. And the issue is now in court. Okay, we are going to be paying, but we don't know how much we are going to be paying, isn't it? Okay, in that particular case, you can see that we have a present obligation, isn't it?
Yes, sir.
We have a present obligation because we have sold goods and now the people have taken us to court. So we have the possibility of paying a certain amount. But the issue is most of the times the amount cannot be measured reliably, or there's no possibility that there will be an outflow of what? Resources to settle this particular one. So although you'll be having a present obligation, but is it probable that we are going to be paying this particular amount? Okay, the possibility is always based on the legal advice. Okay, so the people will be telling you that, okay, there's a 90% chance that we are going to be losing the case. So it means that the case has already been lost. So you have at this particular time, you have an obligation to pay, and they'll always give you the amount also. Okay, so if you count to contingent liability, it's a possible or it's a potential liability, but it being a liability depends on the occurrence of what? An event that is not within the control of the entity. Mostly it's a court case. Okay, so if you count to the contingent liability, you will always be having a present obligation. But what is the possibility of us paying a particular amount? The possibility is always based on the lawyer's advice. So the entity will be telling you, or the question will be telling that the lawyers estimate that there is a 70% chance that we are going to be paying this amount to settle. Okay. So let's come here. If you have a court case, okay, if you have a court case and your lawyers are saying that there's a 70% chance that you are going to win the case, will you be paying anything to settle the court case? Will you be paying any damages to the customer?
Yes, sir.
Will you be paying any damages to the customer? There's a 70% chance that the entity is going to win.
70% is like a good percentage of we winning.
So we are not going to be paying anything, isn't it?
Yes, sir.
So this one, no provision over here. So we base it on the legal advice. But if the lawyers are saying that there's a 80% chance that the customer will be successful, what does it mean?
It means that we'll be settling the customer.
It means that we have a present obligation to pay a certain amount of money to the customer, isn't it?
Yes.
So if you come here, you make what? You make provision. So if you count the contingent the contingent liability, the possibility of making provision is always based on the on the lawyer's estimate. You have a present obligation, but what is the possibility of you paying? It is going to be based on the advice that the lawyers are giving to you. They are going to be giving you the amount as well. But let's come here. The question can give you a court cost. Okay. The court cost, whether you are winning or losing, are you going to pay or you not pay?
You pay.
You pay.
You pay.
You pay before they will even start the proceeding. So for the court cost, whether you are winning or you are not winning, you provide for it. Since you have sent the issue there for the judges to look at it or for the court to look at it, you have a present obligation to to pay the court cost in the in the future. So for the court cost, whether they are winning or losing, we provide for that. Okay, let's come to the contingent asset before I will pick a question on
One say,
yeah, Sina, you can talk.
say quickly. If we are now getting advice from our lawyers that there's a high chance we are going to pay, and then the amount is to be determined. What exactly are we going to recognize as provision
If
we are
no
to
amount
recognize
has been given to you, it means that you can't determine the amount cannot be measured reliably. So you always have to determine the amount. So if they are saying that you are going to be paying, you have an obligation, there's a possibility that you are going to be paying. But how much are you going to be paying? So if the amount is not given to you, you cannot recognize the liability.
So
Okay.
should I disclose in that instance?
Yeah, you just have to disclose. Okay.
Okay.
If no amount has been given to you, but if the entity can make a reliable estimate of the amount that they are going to be paying, then they can recognize the provision. Okay.
Thank you, sir.
Let's come to a contingent liability, a contingent asset. A contingent asset is a potential asset, but each being an asset depends on the occurrence of a particular event that is outside the control of the entity. So there can be the court case, the entity will be claiming that it is the supplier that supplied the goods to them. So they are going to be having a counter claim. They are going to be taking the supplier on also so that the supplier will pay them. Please, any contingent asset of any form, okay, contingent asset of any form should not be what? Should not be what? Recognized. Okay. Contingent asset of any form should not be recognized. Why? Because the amount that a person is promising you, whether they are saying that it is probable, you don't have control over it. Okay, that particular, we say we can recognize assets when we have control over it, we have ownership. You are just taking the people to court. Okay, the amount that they are going to be giving to you, there is no control there. Okay, there is no control there. So any contingent asset of any form, even if the lawyers are saying that there is 85% chance that they are going to be doing this, what you do is you can only disclose. Okay, we don't recognize this particular one. But let's come here. However, in the issue of reimbursement, what do we mean by reimbursement? The supplier is telling you that any amount that you pay to to settle the customer, we are going to reimburse you. Okay, so they are saying that any expenses that is made to settle the liability, there will be a reimbursement. So if you have paid 200 million, you recognize a contingent or a corresponding asset of 200 million, because the people have assured you that they are going to pay you 200 million. So that particular amount will be given to you because you have incurred expense. They say whenever you incur expenses, they are going to be reimbursing that one for you. So as soon as you have incurred expense, it means that those people also have to pay you. In that particular case, you can recognize the asset. Whenever the liability is being settled, any amount that has been spent, you recognize a corresponding asset for that, because that amount of money will be reimbursed to you. Okay, you have entitlement to that particular asset now because you have incurred expenditure. But for contingent assets of any form, they are not going to be doing, you don't have to recognize anything. You can only disclose when it is when it's probable, when it's highly probable. But for contingent assets, the recognition is based on the lawyer's advice and the recognition criteria of provision. Please, financial reporting people, they can ask you the meaning of contingent asset and the meaning of contingent liability. So don't only pay attention to the calculation, pay attention to the definition also. Let's pick just one question on that, and we call it what? Night. Okay, so I'm sure I have a question somewhere here. Okay, Trust.
Sir.
Question number 9. Let's see if question number
Okay,
9.
so question number 9.
I'm
A
trying
company is being sued. Okay,
Okay, you are reading from your distance.
from the screen.
Okay, question number 9 will be okay.
All right. Okay, so question number 9. A company is being sued by a customer. Sir, please, the screen. Okay, yeah. A company is being sued by a customer in respect of some products supplied which the customer claims are faulty. The customer is suing for 220,000 Ghana cedis plus damage. Court costs are likely to amount to 40,000 Ghana cedis. The company's lawyer has advised that there is an 80% chance that the case will be lost and that the full amount claimed by the customer will become payable against the company. The company is fully insured and the lawyer has advised that the insurance policy covers the event and should be utilized. Required. Determine the amount that should be recognized as a provision and charged to profit or loss, and determine the treatment of the insurance claim.
Okay, so what would be the amount that will be charged to profit or loss as a provision?
So the 220,000 plus damage.
Now the damage is the damage is so the amount that we are paying now. The only amount that we have is what is the 220,000 that we are paying, isn't it?
Yes, sir.
They are saying that the issue will be what? The case will be what?
Will be lost 80%.
80%. So it means that we are going to be paying those people, isn't it?
Yes, sir.
Okay, so we have the obligation of what? We have the present obligation of paying what? 220,000 when the court issue has been settled. You see, the case has already been lost. So we are just accruing the what? We are just accruing the money to the time that the court would tell us that the case has been lost, then we pay. So we have that particular money ready. We are just waiting for the what? It's just like you are playing football match. Okay, you know who is going to be winning. So the trophy is available. You are just waiting for the winner to be declared, and you give it to the person. So it's the same thing now. We are going to be paying. We have a present obligation because the people have not taken the issue to court, and we have to settle them. And our lawyers who are going to defend us are saying that we have an 80% chance of losing. It means that we have already lost. Okay, the court case is a single event. It's a single event. So if they are saying 80% of that particular single event happening, it means that we are not going to be winning. So we'll be paying the 220. That is the amount given to us. For now, the reliable estimate, the best estimate that we can make for the damages is what? Is the 220. However, we are going to be paying a court what? Cost of how much?
40,000.
40,000. So what we do, provision will be for the court cost plus what? Plus the 220,000. So we make a provision for 220,000 plus the court cost of what? 40. For the court cost, whether you win or lose, you what? You will pay. But we are here to pay. So we recognize a provision of 260,000 that will be taken to profit or loss. What about the insurance claim? The company is fully insured and the lawyer has advised that the insurance policy covers the event and should be what? Utilized. The insurance claim is what? It's a contingent what?
The contingent asset.
It's a contingent asset. Okay.
Asset.
Before these people give us any amount of money, they're also going to be doing a lot of things. So this is going to be the asset. Having the amount depends on what those insurance companies are deemed to be what? Deemed to be favorable. So they will come and look at the situation and see, okay, does the insurance policy cover this particular activity? Then they will also do a lot of things before they give us the money. Okay. The only thing that they can do over here is to what?
Is to disclose.
Is to disclose. Okay, because it is possible that it is probable that they are going to be receiving this money. So the insurance one is a contingent asset which should not be recognized. Contingent assets of any form should be disclosed or should be ignored. Okay, But if it should be a reimbursement that the insurance company is doing, so we can recognize the contingent asset or reimbursement based on any amount that we are paying to settle the obligation. This is for the contingent asset. In any case, the provision should be based on the lawyer's estimates. We have a present obligation, all right, because the issue has been taken to court. So it's probable that we are going to be paying certain amounts of money. But the issue is, it is the court that will determine for us to pay or not. But those who are representing us, what are they saying? They are going to be defending us. What are they saying? They are saying that there's an 80% chance that we are going to be losing. It means that we don't have case. We don't have a case. We don't have a case. So we are just appearing there as form of what? Appearing there. We have already lost the case. So what we do is that we have to settle now. But what we are doing is that we are not going to be settling now. So we recognize the provision, or we recognize the liability, and accrue it to the time that we are going to be paying. That's how we go about it. So the entity should make a provision for the amount that the customer will be getting, which is the compensation, because they have a present obligation, and it's probable that there's 80% chance that they are going to be paying the amount, which is a single amount, and the amount can be measured reliably, 220,000. For the court cost, whether you are winning or you are losing, you cannot avoid it. So for the court cost, it's an unavoidable cost. So we can say we make provision for unavoidable cost. Someone can also put it like that. We make a provision for unavoidable cost. For the insurance claim, it is a contingent asset, and the lawyers are saying that it is possible, or it is probable that they are going to be receiving a certain amount of money from the insurance company. So that can only be disclosed as there is this particular goods has been insured, and we are expecting some reimbursement or compensation from the insurance company in respect of this. That should be the disclosure. Yes, seniors, that is the end of it.
All right, sir. Thank you very much.
Thank you.
If there are no issues, I'll see you guys on Saturday. All right. On Wednesday dawn. Okay, we continue with the introduction to. All right, so that is it.